A warm welcome to everyone who's joining us either this early in the morning in Europe, Africa, Middle East, or in the evening down over in the Asia Pacific region to Australia, New Zealand. Our first panel will have people from around the world, two panelists from a wonderful summer region, and that's I have to excuse why we title our today's series of conferences under the sustainability. Number one, winter edition, because of course it's not winter in your countries, it's summer, and we are all jealous north from the equator. I have to say, Frankfurt is damn cold. But having said that, I want to warm welcome to everyone, and a big thanks to my colleagues Adam Cotter, Marcus Prach, Christian Gärtner, who has helped to bring the content. Again, also a big thank to our partners here, in particular Hans-Jürgen Walter from Deloitte and his team, and not to forgotten finally as well the Malecki Group, where you might see today and you wonder why Nader Malecki, the well-known senior and founder of the group, is not around. That has a clear region. It's not a complete handover, but it is a handover to the next generation. We are welcoming here Darius Malecki, one of the new faces, together with his sister Samira. And we will see them more often, not on screen, hopefully also on stage in the outlook for the coming years, 2022 and following. But these are our partners. What do we want to discuss? We have kicked off that series, unfortunately, when the pandemic brutally kicked in spring last year, 2020, and we all felt very much handicapped for our daily lives, business lives. And since then, we had to shoulder a tremendous amount, not just of money, also of pain in our families and surroundings. So that for these conference and that series hopefully helps a bit to get better connected, even not in person. As I said, that hopefully will change throughout the coming year. But I have to say, we from DZ Bank, we are very proud that we can contribute and bring these people together. Follow the sun was our motto, and created. We always start, obviously, that makes sense in the Asia Pacific region, as of today as well, with Australia and New Zealand. And then Greater China and Southeast Asia will come in. We will hear people from Middle East Africa, from Europe as well. And we finished then with contribution from Americas. Myself, I just came back from my first business trip last week. I had the pleasure, did my own little IMF, I have to say. I went to Washington, D.C. and just there. And it was great to see the people face to face after almost 2 years. Many people from the World Bank Group. There was Jingdong Hua, who is leaving the World Bank as a treasurer. His successor, Jorge Familia, was there, and present people who has not seen even among their own office themselves for almost 2 years were very happy. They almost fell in their arms. They took photos. So it was very emotional. I wanted to say that because this is also an outcome of the pandemic. And if you are then brave and going to start protect yourself, seeing each other, that should help. Beside that, I saw people from the US Treasury and as well from many other institutions over there. And my impression, that's why I was mentioned that unlike we had seen that under President Trump, here Washington and the international institutions, but also the Americans themselves are very much committed. And that was my deep impression, that they are willing to support, to take a lead as well, partly, and a change. So that gives me the feeling that these three major time zones, Asia Pacific, Greater China, Middle East, Africa, Europe, and Americas North, South, and Middle, I think really working together to make these a more sustainable and resilient world from whatever is coming in front of us, and that we have a future for our coming and current generations. But let me come back to the conference itself. We have participants from nearly 20 countries. 35 people will contribute today, and we will stop Frankfurt time in around about 6 hours from now. In between, we will see and discuss many topics. I will not take take it away from Darius here, who will come in and introduce now in a minute a couple of these panels and give us the red line throughout the half day today. Just allow me one comment. When I came back from COP26 Glasgow a couple of weeks ago, I saw a lot of positive press around, but to be quite honest, beside the fact that the Scots were an excellent people, friendly people to support all the visitors there, it was not the same COP as I have seen before in Madrid, Paris, and other places, because people couldn't run by accident into each other and created momentum and do things. So just to say, there is still a lot to do and to go, and I do hope that as the British or the Englishman would say, that we all walk our talk and take action and deliver. But let's hope we will create some momentum today when we listen to all these wonderful people who decided to stay awake or wake up early in the morning and contribute here. I wish you all and us a big success. I will come back in roughly an hour and a bit to introduce Mr. Erkki Liikanen. And so, Darius, hand over to you. The floor is yours. Thank you very much.
Thank you so much, Frank. Good morning, everyone, wherever you might be watching, wherever you might are. It is a great pleasure to welcome you all to this very special conference, Future Europe, Sustainable Europe. Frank is right. We started last year in 2020 with a mission to build a global community for sustainability. It doesn't really matter what a person does. The most important thing is that there is a fascination and an ambition to have a coherent sustainability strategy to drive a net zero economy. So what Future Europe actually stands for is bringing investors, issuers, advisors, consultants, and politicians together to drive this initiative. Looking at the community where we are right now and where we were last year, it is amazing to see how much we have grown. Having now today, as Frank already said, 35 speakers from over 20 countries shows the importance of the topic and the importance of such a community, which we all invite you to join and also to support us to continue to grow this very special community. Because it is up to us to design this very new special world that we are living in and the exciting changes that might come across our path, and especially in business, but also private-wise. I would like to thank again DZ Bank very much for the collaboration in the last year and this year, and hopefully in the next coming years. And Deloitte, Hans-Jürgen Walter especially, but my very special thanks go to Adam Cotter, the mastermind behind the program, bringing together all of these experts here in this virtual conference that we have right now. And as Frank already mentioned, that we hope to do this also in a hybrid or even an in-person model. So Frank already said that I would go through what is going to happen in this very special conference day. So we're talking about emerging markets. We're talking about a carbon neutral economy. We will talk about investor relations and why it is very important to have global standardized methods, especially in accounting standards. This is why it is also my great pleasure to welcome Erkki Liikanen and the IFRS Foundation, not only to this conference, but also to Frankfurt, my home, Frank's home, our home, and the base of the Future Europe community. That said, I would like to thank you all for coming. Thank you all for your commitment, and I'm very much looking forward to watching this conference and to seeing what have we planned for 2022. What can we do? What can actually be done? It is going to be an exciting year full of changes. We are looking at a new world that is coming across. So let's see what is going to happen. Adam, I'm handing over to you. We have now an exciting panel that is starting. We have people from Auckland, from Denmark. They're so far away, but maybe they have similar interests or similar plans. So we're very much looking forward to hearing this. Thank you all. It was my pleasure and see you soon. Thank you so much.
Thank you, Darius. Thank you, Frank. And yes, and good afternoon, evening, and morning to all of you. My name is Adam Cotter, and I'm from DZ Bank and joining the conference from our offices here in Singapore. It is a real pleasure to welcome such a diverse group of policymakers, investors and issuers throughout the day, and I'm pleased to be kicking things off with a really interesting panel on how the transition to net zero is shaping institutional investors' portfolios. And joining me to do that, we have some great thinkers from leading asset owners in the sustainable investing space. Joining me on the panel are Sybil Dixon, Governance and Sustainability Manager from UniSuper in Melbourne. We have Will Goodwin, Head of Direct Investments from NZ Super Fund in Auckland. Louise Agard Jensen, ESG Manager from PKA from the suburbs of Copenhagen. And Maren Maloney, Head of Responsible Investment and Governance at the Environment Agency Pension Fund, who also has a role at the Transition Pathway Initiative, joining us from Bristol. So thank you, panelists, for joining me. We are quite short on time, so I'd like to just jump straight in, and perhaps we can start with Sybil. And it would be great to perhaps if you briefly introduce yourself, but also your organisation, and what net zero means for you and UniSuper. Over to you, Sybil.
Fantastic. Thank you very much, Adam. So my name's Sybil Dixon. I'm from UniSuper, which is a super pension fund for the Australian university sector. We have roughly $100 billion AUD, which is about 60-odd billion dollars of euros. And we set our net zero 2050 target in September 2019. That target is supported by our 2030 target, which is to contribute to a 45% reduction in Australia's emissions, which is a collaborative engagement initiative. And we set ourselves a short-term target to have our top 50 Australian investments, which represent roughly 65% of our funds under management, to have Paris-aligned operational targets by the end of this year, which is now in like 3 weeks' time. So it was a very short-term target. So now it's been really exciting to see how the engagement that we've had has really sort of accelerated over the last couple of years. But I'll leave it there because we've got plenty to talk about.
Thanks, Sybil. Now, I've always thought it'd be quite interesting, given how many climate change academics or environmental scientists must be part of your fund as well. But over to you, Will, in Auckland.
Good morning. Thank you, Adam. Kia ora. My name is Will Goodwin, Head Direct Investments at NZ Super. We're a little bit smaller than most on the panel. We're about $60 billion. But what does make us a bit different is the growth trajectory that we are on. We are a very rapidly growing pension fund, not just from the contributions, but our own returns that will see us grow to about the $1 trillion level by about 2080. So that's under the government's base case forecast. So as a very equity heavy investor, we have a very strong and aligned interest in ensuring a even and just transition. We commenced our climate journey really in about 2016, where we went through a process of decarbonising our portfolio. And today we've removed around 94% of our reserves and about 47% of our emission intensity already. On top of that, though, our government has already signed up through to net zero by 2050, and alongside that legislation is following through into our fund. So we have that as a requirement, but alongside it, we've also recently signed up to the Paris-aligned investment initiative and the net zero asset owners commitment, which is about $3 trillion of capital, which again are creating alignment and drive towards a net zero. So yeah, it's just base case for us now. We are now rapidly transitioning our portfolio and hoping to get there well before 2050.
Thanks, Will. I know that the fund has come just off some of the strongest performance in the history, a relatively shortish history compared to other funds, but it seems like it's going to be quite a comfortable place to retire in New Zealand around 2070 or 2080. And Louise, please, PK is a bit of an older fund. Great to hear more from you.
Yeah, thank you, Adam. So my name is Louise Jensen. As Adam already presented, I'm an ESG manager at PKA, and PKA is one of the largest pension funds in Denmark. We have around 335,000 members from the Danish social and welfare sector, and 90% of our members are female. Our asset under management is around 50 billion euros, and PKA has been focusing on sustainability for quite some time now. It's been even some decades. It started back in the late 1980s, where our members started to require for PKA to take efforts to invest responsibly. So from there, it has been quite a journey, and it has been accelerating in particular from 2010, where PKA made its first green investment. And based on this experience in 2010, where we invested in our first windmill farm here in Denmark, we have developed expertise within the area and have grown our portfolio of green investments. So we were able to set a target back in 2015 that 10% of our asset under management should be invested in green investments by 2020. And we made this goal, we accomplished this goal in 2020, and then set a new goal of investing some how much is in dollars? Yeah, 6.7 billion euros, in green investments by 2025. I think it's important to mention that at PKA, we have the belief that return and sustainability can go hand in hand, and that's possible. So we keep on developing this or approach on how to integrate more sustainability, and we consider that we are on a journey, and that we have been the last few decades. And in 2021, we decided to commit to become CO2 neutral by 2050. And we did that also by signing up for and committing to the initiatives, the Paris-aligned investment initiative and the Net Zero Asset Owner Alliance. And then also in Denmark, we have a very national specific initiative called the Danish-led Climate Reporting Initiative. So we're following these three initiatives at the moment. And PKA has also taken part in the development of the Paris-aligned investment initiative through IIGCC, and the development of the underlying framework, Net Zero Investment Framework. So so for us, I can only say that it has been, the frameworks have been a really great toolbox for us to get started on our net zero strategy. And I will only encourage other investors to also to participate in these global initiatives that really bring us together to find pathways of how we can accomplish the objectives of the Paris Agreement. But we do believe that it's important to take action already today if we are, and we all need to contribute if we are to succeed with the Paris Agreement. So yeah, that's a little bit about how we approach it.
Great, thanks, Ruth. I know, as you said, about 90% of your members are women, and I think most of those are from the healthcare sectors who've been playing a very important role, of course, over the last 18 months. And last but not least, we have Marion joining from my favourite city in the UK. Marion, over to you.
Hello, good morning, everyone. And sorry to disappoint you, Adam. I've had to come to London to speak to those scientists now. So actually, behind me, there's a fantastic view of London, but for the purpose of this telecom, I won't do that. I won't show you. So I'm from the Environment Agency, and actually about 20 years ago, so the pension fund got a bit of a kicking because we were invested in companies that then our employer body, the Environment Agency, the regulator, was taken to court, and notably it was oil and gas companies. And 20 years later, I'm still getting lots of inquiries about oil and gas, but I'm sure we'll come on to that later, Adam. Can I just mention about Louise's point around the trade-off? And I think this is really important because, you know, we've had a long track record on this. I can tell you over the last 10 years, we've had returns of about 11%, outperforming the market by something like 1.1% year on year on average over those last 10 years. You don't have to have a trade-off. I was in a discussion yesterday with some lawyers around fiduciary duty, really key to this debate. But there's assumption that you're starting with, you have to take an impact. What is the implications? And our experience has been that you don't. Anyway, I just wanted to put that out there, talk about net zero. So we started looking at net zero only within the last year. We spent 9 months looking at it, 6 months looking at the investment strategy, what we needed to do around that to make sure that we were aligned with a 1.5 degree world. And then 3 months looking at fiduciary duty with my lawyers. So you can see it's kind of at the front of my mind. And in terms of the investment strategy, what that meant for equities, what fixed income, what that meant for 4 in terms of our engagement. 2 things I wanted to add to what other panelists have said. For us, adaptation is a really big issue. How we understand the physical risk in our portfolio, but also kind of that broader, wider societal resilience issue, I think is important. Nature and biodiversity is something we're really looking at very closely, most notably in our forestry and agricultural holdings. But more broadly, I'm very interested in the listed equities. How can I, as a asset owner, understand the biodiversity risk in my portfolio? Anyway, after 9 months of number crunching, going through committee, speaking to lawyers, we came out with a target which was 2045, and it met with almost universal dismay from our members, who immediately said, why not earlier? Why are you waiting to 2045? Now, we went for 2045. We could see, actually, we were 5 years ahead of that decarbonisation pathway for 1.5 degrees world. That cut no mustard with our members. They were, this is really disappointing. 2030, I just 2 weeks ago had my first members AGM. They met the committee. They could ask them anything. Loads of questions around why not earlier, why not 2030? The Environment Agency is headed for 2030. And so I explained around, offsetting, and we're not offsetting. And again, there's issues there around fiduciary duty, but also in terms of having the right mix of products, risk, returns. All of these are really key. It's quite complex, I think, for a net pension fund to factor all those in to get to net zero. But anyway, ultimately, there we are. So 2045, it's under review. I think all of us will have to constantly review the data, the climate science, see we're on track, what's out there in terms of investment products. It might be we can get there earlier, but certainly at this point, I think even 2045 is going to be quite tough, even for a kind of a green fund for us. We're open defined benefit. We need to factor that in terms of liabilities running right into the next century. Thank you.
Great, thanks, Mary. Well, let's carry on that theme of the sort of trade-off and whether we need to either just save the planet or generate returns. Maybe if we go back to Sybil. I mean, how do you as an asset owner contribute to this pathway of a lower carbon economy?
Well, to that question around fiduciary duty, as UniSuper as a fund is quite active in the way that we're positioned, and essentially sort of the way we kind of squared the circle, for want of a better phrase, is by considering, just looking at decarbonisation, looking at all of the targets that have been set globally, and essentially saying to us, decarbonisation is a major investment theme that will impact across all sectors of the economy. And we want all of the companies that we're invested in to be participating in this transition as much as they can be, because it is something that is important. It's something that is being encouraged. And so by having that as a key investment theme across our portfolio, we're kind of able to draw in that fiduciary duty. We think it's critical that we are considering this and are actively participating in this transition in order, to best meet the financial interests of our members. So that was sort of the way that we considered that, in a way, like technology was, what the internet was 10 years ago, what the PC was back in the 80s. That's sort of where we are with the decarbonisation trend. And regardless of, what companies you are invested in, you've absolutely got to be mindful of the opportunities that technology has presented. Similarly, we have to be absolutely mindful of the opportunities and risks being presented by decarbonisation. Does mean different things to different companies, but we absolutely don't see it as, don't see it as a negative per se. And we do think that we're doing what our members want, but also what is needed. And at the end of the day, with all of the forces that are happening, the technological changes that we're seeing, we're hoping that we can see that it's really about the speed of change rather than, and we sort of hope really that it's inevitable now, but it's now about how quickly, and it's something that's accelerating. And if we're not encouraging all of the companies that we invest in to be mindful of this, then it's, and in particular, companies that are highly exposed to the transition, then, they will find themselves in a lot of trouble, and we're seeing that already.
Thanks, Sybil. Yeah. Louise, going on to you. You already said that your members were very vocal about this sort of transition several decades ago, I think, right in saying. So, how as a fund do you sort of measure your carbon reduction and prove you're doing what your members want you to be doing?
So I think you can say that our net zero strategy is mainly focused on 3 pillars. And And obviously one of them is how do we reduce the CO2 emissions from our portfolio. And here PKA we have measured our scope 1 and 2 for carbon emission for the portfolio, including 3 different asset classes, the listed equity and corporate bonds and real estate. We are now we're looking into at the moment we're developing our strategy and setting PKA's 2025 CO2 reduction target, which will be based on carbon footprint, the carbon footprint measure. And over time, the next year, that's the next step for us is to consider how we can integrate even more asset classes until we can cover the whole portfolio. And also over time, we are looking to how we can include scope 3, obviously. I think it's important here to mention a really important part of the strategy, which is also like the second pillar, you can say, is exercising active ownership in order to push companies to become CO2 neutral and to commit to becoming CO2 neutral. And here, when we're setting these short-term goals or targets, that's one of the things that we have been focused on. How can we set realistic CO2 reduction targets when we also very much depend on investee companies to actually reduce their CO2 emissions for us to be able to reduce it. So PKA is very active within the initiatives such as the Climate Action 100+, which is engaging with the 167 companies that the largest CO2 emitters around the world, and pushing them to commit to setting a strategy that's aligned with the Paris Agreement. So that's some of the things that are very key to us. We for us to have CO2 reductions and not just and for it to be really to be supportive of a green transition. It's important that we have the companies reducing their CO2 emissions along with our portfolios. Because one thing we have looked into is also, okay, but we could just set a portfolio tomorrow where we sacrifice on our diversification and only invest in consultancies and companies that are having a very low CO2 reduction. But that's not really the right approach if we want a green transition. So that's one thing that we are very active in, exercising active ownership, voting on general assemblies, speaking with companies, and engaging in these global initiatives such as Climate Action 100, and also the Paris Aligned Investment Initiative and Net Zero Asset Owner Alliance. They all have focus on this. So that's some of the key pillars, you can say. The third pillar I have already talked a little bit about. It's how we approach also investing, like choosing some positive investments that we can include in our portfolio, such as green investments. Right now we're looking at investments in Power to X and how we can grow our portfolio of green investments. So you can say that's more or less how we approach it. But it's not straightforward. There's definitely a lot of challenges on the way, and as Sylvia, I believe, also said, or maybe it was Marion, but we will have to recalculate. We're waiting for more data. We will have to integrate more asset classes as long as we go, and then we need results from the companies as well. So it's really a matter of it's a journey, and but we have to get started now, and then we'll develop as we go.
Thanks, Louise. Yeah, of course, institutions like the Transition Pathway Initiative are producing some great data, and perhaps Marion can share a bit more on that later. But just on this engagement issue as well, we'll bring Will back in. Obviously, Will, you said that the New Zealand Super Fund is very equity heavy, but also has quite a good amount of direct investments as well. How as a fund do you sort of approach engagement and changing or working on company behavior?
Yeah, so very much like Louise's comment, we have effectively 4 pillars to our climate change strategy. The first is reduce. So we've done that. We've gone through, we've understood how we can, on a risk-adjusted basis, get the reductions in the emission and intensity to a level that we set. So initially the targets were 80% in the reserves and 40% in emission intensity, which we've now achieved, and we'll continue to push those forward. It's important within that reduced framework, though, that it's not just a pure exclusion model. We do use our own internal models in which we do, to keep it short, reward companies that are funding and supporting the transition. So we want to keep and support those companies in our portfolio. We just don't exclude all of them. So it's quite an active model. So that's the first page, first pillar. Second one is we've got to analyze. We've got to understand then what we own. And with what we own, how do we then continue to improve the environmental outcomes that we have with the assets? So that's engaging with the companies that we own. It's within a direct investment policy program. How do we reduce the emissions from our farms or build green infrastructure or green star housing, etc. Then once we've sort of looked at ourselves in the mirror, then we go, right, how do we then use our portfolio for good? How do we start creating impact? How do we start engaging and forcing outcomes with our investee companies? And then the last leg of it is the search. That's the bit where we've got to be casting ourselves, sounding a bit Mark Carney, out to the horizon, and thinking about where are the opportunities and where can we start deploying ahead of others to take advantage of the climate transition. And I'll just sort of borrow and reinforce the comments that Marion just made. I mean, since we decarbonized the portfolio, on an even risk basis, we haven't taken any more risk as a result of that, and we've achieved a 60 basis point per annum improvement in our performance. Albeit it's a short timeline, but from a fiduciary or whatever you want to call it, it has been a marked improvement in the performance of our portfolio.
Thanks, Will. Well, Marion, let's bring you in there on the same sort of points, and then whether you ever think divestment is justified.
Yeah, I mean, listen, I think we have to engage. I'm finding this panel really encouraging, to be honest, because, all around the world, investors are trying to make this change and trying to put pressure on these companies to change. Now, if I can start with my members, because I mentioned about a 20-year horizon. In between, I actually worked for the environmentally regulated oil and gas industry. So it's kind of almost has been a permanent factor in my life. We're at the stage now, I've got 8 oil and gas companies in my portfolio. It might be reduced as of today. But anyway, the point is, I've got 84 times as much money invested in climate solutions than I do have in oil and gas. But those oil and gas companies completely and utterly dominate discussions with members, or at least they did. And so what we've moved towards in our equities for our passives is a Paris-aligned approach. So basically, unless those companies on the passive index are in line with Paris, they fall out. So naturally, I think some of those oil and gas companies will fall out. But if they get to a point where they're aligned with Paris, 1.5 degrees, they could come back in. And in fact, the day that I had my members' AGM was the day that the Transition Pathway Initiative, the TPI, announced that actually, for the first time ever, 3 oil and gas companies had plans in place which might get them to a 1.5 degree world. First time ever they've announced that. And so I had a look at one of the plans, Total, because we hold Total, in terms of what they were looking to do. And so what I explained to my members that actually they could come back into our portfolio if they are 1.5 degree aligned in the future. And I'm not saying that, okay, great, tick, they've got the TPI box, they can get back into the index. What I'm saying is all of us in terms of our investment community have to keep putting pressure on those companies to make sure they're delivering what they say they will deliver, and actually those emissions are in line and they're, they're meeting all the requirements and the governance is correct, etc. So I think that's the journey. Now, why do I keep banging on about engagement and not saying, let's just pull out oil and gas companies, because isn't that the obvious answer? This is a fact I learned from Oxford University yesterday. Less than 5% of total global oil and gas reserves are held by the large listed oil and gas companies, the sorts of things that everyone's trying to pull us out of. Instead, the rest are all held by state oil and gas companies right around the world, Mexico, Iran, Iraq, wherever. So we have to wean off the whole economy. And I think it has to be more than just about oil and gas, this debate. It has to be about, paper, cement, steel, all of those industries, through to Tesco's and the local retail companies, about that decarbonisation agenda, so that we can all win ourselves off oil and gas, and we put pressure right across the board. And I support what everyone else has said on the panel around stewardship in relation to that.
Right. So do you think sorry, I was just going to ask if you think the investment industry is ready to put on this pressure?
Yeah, I think it is. I mean, what I'm seeing in the last year or two is a huge amount of interest in this area. I was having a debate with somebody at dinner last night about, in the UK, there's been quite a lot of laws around disclosure. The financial sector is really interested in. If that financial sector behind me in the City of London is only interested in making a quick buck, to be honest, I don't care. If they're putting that quick buck in the right place and they have to make all these legislations and all our asset owners, and we're putting pressure on them, we're getting the right data we need to see them making the right, they've got a lot of power. So I'm saying, I think it's moving in the right direction. Now, the question is the urgency. Is it moving quickly enough? And I think that might be another debate, Adam. But I'll shut up there.
Sorry, thank you, Mary. Okay, back to Sybil then. I mean, we've heard about the urgency and sort of engagement strategies as well, but who are the other sort of key partners on this journey, especially for a fund like UniSuper?
I think they've already been mentioned. Maybe not the Australian version of the IIGCs, which is sort of our most sort of closest industry association, for want of a better phrase, that really helps set the standard. I can't talk about climate and not talk about the TCFD and the work that they've done there. And I know when I started looking at climate, the TCFD was announced and there was all of these acronyms and I was like, oh my God, I'm never gonna, but it really did allow for a sense of clarity around disclosures and reporting when it came to climate. And I think just having a framework by which to talk about this transition has just been so powerful. And now we're starting to see, with the sort of more formalized and global reporting standard and the group that was set up at COP, I think that will just spur on even more better disclosures, which I think are really important. But aside from that, just the ones that have already been mentioned, groups like the Investor Agenda, Climate Action 100 have just been absolutely invaluable. And I think setting increasing expectations about what we can expect for, a lot of these sectors are really hard. And, I think engagement is incredibly important, but I think, and this is sort of to Marion's point around, how ambitious can you be? At the end of the day, you need to set targets that can galvanize people and not put people off. And I think one of the challenges with the 2030 target, as an investor, if you want to move people with you, you need to make it seem achievable. And I think for a lot of the hard to abate sector, if you have targets that are sort of, you can't, like the technology is not there yet, or, for the point about, the oil and gas industry, if you're not engaging with the demand side and you're only talking to the supply side, there's demand for the product. If you don't get rid of the demand for the product. So one of an example of company engagement from our perspective, we've got a large holding in a gas pipeline company in Australia. And one of the things that they've been doing in the last month or so is talking to the Victorian regulator of their gas pipe, because they do the pipes to the houses and stuff, about shortening the asset lives as part of, the regulated asset-based calculation. So that's sort of a live example of what a company is doing, with mind to the fact that the Victorian state government has set in place a target to be net zero by 2050. That's not compatible with an asset life that's now 50 years from now. So, you've got to have those conversations around, what is the asset life? And if this is a regulated asset, that needs to go into the calculation. So they're the sorts of things that, it's not sexy, but it is definitely part of the conversations that need to be having. At the same time, that company is also looking at electrification and all of these other things. But, in order to protect investor returns and lower the risk of stranded asset risk, these are the sorts of conversations you should be having. And I think by having really engaged investors, it helps, push this ambition along.
Thanks, Sybil. And Louise, do you want to react to that? Obviously, Denmark has quite a sort of developed ecosystem in terms of this, or is it just up to the asset owners and the investors to sort it all out?
Yeah, so I very much agree with Sylvie. Many of these global initiatives are also some that we are following and following the development of, for example, the TCFD reporting. That's something that we PKA is using very actively, and we see is really a really great tool in the future. So TCFD reporting, you have great work coming out of the European Union that's really drafting regulations within sustainable finance that will make it all more approachable for us here in the EU. For example, the EU taxonomy is coming into place that will help us really knowing when an investment is green and when we cannot consider it green. So that's something that we are very much looking forward to the full integration of all the EU work. But you also have the global initiatives from investors as well. You have the Net Zero Asset Owner Alliance, the Paris Aligned Investment Initiative, and you have the GFANs from that came. There was an initiative developed at the COP in Glasgow, and you also have the global engagement initiative such as Climate Action 100, which has also proven to be very, very useful and powerful tool to really move on this agenda. But I think, as you also mentioned, like it's not something that can just be on the shoulders of asset owners. In order for asset owners to actually succeed, we need the entire society to contribute all together. We need everyone from investors, investee companies, suppliers, the data suppliers, consultancies, asset managers, politicians, and even the consumers to be having this mindset to really move and ensure we have a green and more rapid transition. So just to give an example, for example, legal barriers are still a hindering for a more rapid transition, even in Denmark, because for example, in Denmark, we have the institutional investors are legally obliged to always consider the prudent person principle first. We must deliver the best possible return to our beneficiaries. And we need what we actually really need is also for the legal requirements to be supporting on the transition to net zero. So we have all these initiatives in Denmark that are all moving towards a greener future and a more sustainable future. But then we kind of have to revisit some old laws that also need to be supportive of this. And that's one challenge that we face. So we need everyone to contribute, and we need the whole entire value chain, so to speak, to be involved. Because in the end of the day, if everyone is asking for climate-friendly solutions, it will eventually become the new normal, and that will ensure a more rapid transition. So that's some of that's how we look at it.
Thank you. Thanks, Louise. I'm conscious we are quickly running out of time, and I think I might get politely asked to wind up the discussion soon. But before I do that, I do want to get one more question into Will and Marianne. I mean, you touched upon it or briefly mentioned moving investments into specific sectors that may have traditionally been outside of normal asset class structures for pension funds. Are there any sort of specific technologies that excite you, Will, that you're looking at very keenly?
Yeah, I think every single pension fund in the world now has a renewable energy development platform somewhere around the world. But there's just a significant amount of capital that's now being deployed into this area, not only to help funds themselves achieve the climate objectives that they've set themselves, but in of itself, the tailwinds that are coming through the sector in terms of the greening of the economy, electricity production, and the technologies that are going to be coming off the back of it. It's a sector that, as we've seen even recently, you very kindly talked about our return, Adams, but I wish I was a US university endowment fund with the level of VC investment those guys have had and have seen, phenomenal returns. Again, the investment in the technology that's being driven is fantastic, and that's being seeded and funded by the capital that's driving the outcomes. And one area that is hard for funds to get their head around, though, is how do we invest in these grey assets? How do we transform assets that are high polluters into green assets? When we sit there and report and say, well, we've got these emission reduction targets, to then bring in a heavy emitting company to then transition it is quite a challenge, and there's a lot of work ongoing and being thought about how do we account and measure those. But those are the types of investments that actually have the big impact, right? It's great to say that we've reduced the carbon of our portfolios, but all we've done in some respect is move the chairs around. The big changes are going to have by very conscious and deliberate investments to create those those changes. And I will call it, CDPQ, for instance, recently in its climate change strategy, and that's $10 billion sleeve of capital, which is specifically targeted at heavy emitters and driving down those emissions. And I think that's a trend that we're going to start to see asset owners actually standing up and owning the responsibility to drive a lower carbon outcome, rather than just investing their capital to sort of achieve whatever metrics they sit at the portfolio level.
Thanks, Will. Marianne, I think I know the answer to this already, but you must see a lot of opportunities to buy grey assets and turn them into green.
Yeah, we do. Yeah, we do. But can I finish on a green point, Adam? Because actually,
Sure.
When you talk about what's exciting for the future, for me, we spent the last 6 months looking at a really interesting nature-based solution. It was sustainable forestry in Paraguay, and we've got sustainable forestries all around the world already. The difference for me in this one was how we could make that really strong return, do really good stuff in terms of local environment, local society, but also in terms of permanent carbon removal and that offsetting. And what I'm seeing is lots and lots of greenwashing around offsetting, carbon trading, etc. And for me, I think if we could nail that in terms of, not just any more environment, society, governance, but also permanent carbon removal, I think that would be fantastic. It'd be like up to 4. And if I could just say, I think as a fund, on that one investment alone, I think we've cracked it in terms of a nature-based solution to help climate change mitigation. For me, the holy grail is, can I get there in terms of climate change adaptation? Can I invest in something that's going to actually reduce or build societal resilience to climate change and a changing climate? So I'm not there yet. If anyone's got any ideas or investment opportunities, we're definitely open to hearing about that. Thank you.
Well, that's a very positive note to end on. So thank you for that, Marianne. I am being asked to wrap up the session. I'm sorry it's been so short and such a whistle-stop tour. There's lots to discuss, and hopefully we can do it in person at some point in the future as well. But thanks again, Sybil, thanks Will, thanks Louise, and thanks Marianne, and hope to continue the conversation with yourselves and the attendees as well going forward. Thanks. Thank you very much. So from me in Singapore, I'll pass back to my colleagues in Frankfurt.
Thank
you. Bye-bye.
Ladies and gentlemen, we continue our conference, which has just started to finish the first panel. Thanks to Adam Cotter and its panelists from Australia, New Zealand, Denmark, the UK, and you as a moderator down in Singapore. Thank you so much. We're continuing now with a very prominent person. Before I mention his name and his position, let me come back to what we just heard. How is net zero impacting the global investor base and its positions in the portfolios? Let me call it a little bit shifting the trillions towards to a sustainable mission. And here we are. We need to have conditionality about it, and for that standard setting. And that while I was myself at the COP26 this year in Glasgow. Exactly on November 3rd, we heard the great news that the IFRS Foundation trustees announced to set up its ISSB board, which stands for International Sustainable Standard Board. And guess what? I'm very proud of that, not because I'm German, because we have the ECB here in Frankfurt. The new seat of the board will be in Frankfurt. And so that means Frankfurt will set the standards for the world, not because it's Frankfurt. We are so close to the ECB. And a good friend, and I think we have that in common, Erkki, is Frank Elderson. Frank Elderson is by passion someone who stands for sustainability as well. Frank was formerly serving at the Dutch Central Bank and is now in charge at the ECB for legal and sustainability issues. And he is sharing also board at the Basel Committee. And one of his close partners and friends is a former member of the advisory council of the ECB, which is Mr. Erkki Liikanen. Mr. Liikanen is now since October 2018 the chair of the IFRS Foundation up in Helsinki. That's where he is based. You see his picture here already, and we will all have the pleasure to listen to him in a minute. Prior to that, he was serving in various international and national positions. His longest was as he was serving prior to the current chair as a governor of the Bank of Finland. And before, he had two positions to be a commissioner in Brussels, one time for budget and one time for enterprises. I think this is giving him a huge knowledge and a wide range, not just of the financial market scenery, as well of the real economy, beside the fact that he has cope and deal with politicians, which is a dimension in itself. Erkki Liikanen, welcome to our conference here today. Not myself, also Hans-Jürgen Walter, my partner here today on this panel. We have the pleasure after your speech to ask you 1, 2, 3 questions. We are very proud to have you. We are on your lips. Listen to what you have to tell us, how the ISSB is going forward. How is it to be stuffed over the next couple of weeks and months, but we also want to listen to what you have to say, what standards it will be set, coping with a COP26 agreements and its coming COPs in 27 from Egypt and Sharm el-Sheikh and so on and so forth. Erkki, I hand over to you. Thank you very much again for joining us today.
Thank you very much. Actually, I was last week in Frankfurt. I come back to that visit very soon. But just a couple of words about the whole sustainability reporting landscape. It has been very difficult to understand and follow because there have been so many different international initiatives, some voluntary. There have been multiple standards and multiple audiences. And there have been also jurisdictional initiatives. Different jurisdictions have different requirements. Their scope vary and ambition and space. At the same time, there have been so many different people have spoken about alphabet soup. As they spoke alphabet soup in 2008 when complicated really products confused the market and led for their part to a crisis. So due to this situation, this alphabet soup started to be a dominant problem, and it was very costly and complex to report. Also, they say markets were worried that there's a greenwashing risk. You don't really know and can't control or audit what these standards means, how they've been applied. There's been also lack of global comparability and consistency. So many issues have been on the table, and then actually, a year and a half, 2 years ago, many organizations, many people talked to us that IFRS should play a role in this territory. So IFRS has a global role and reputation in financial reporting standards, which I applied fully apart in 144 countries. And they thought that we should start to do it. But we were we were careful not to run to this issue because we want to have it demand driven, so that the stakeholders want us to. First of all, stakeholders must agree that there's a need for global sustainability standards, and second, that there's also clear wish expressed that we should start working in that area. So we started this kind of consultation last year, and 750 letters and comments came from around the world, and there was more or less unanimity that we need global sustainability standards, unanimity. And that, of course, gave us a lot of backing. As to the role what IFRS should play, there was more divergence, but clear majority also there that said that we should play a role. Because, of course, when we are serving investors, we are applying in 144 countries, investors would know what kind of player IFRS is. So on the basis of this work, we then presented in Glasgow, 3rd of November, an action plan, which partly was a surprise to Glasgow audience, even though they are very knowledgeable people about climate. Perhaps what was to be expected is that we will set up, form an international standards, international Sustainability Standards Board, ISSB, which has the task to prepare these standards. In the proposal, our proposal is that it should sit inside IFRS Foundation. On the one hand, you have the financial reporting standards. On the other, we have sustainability disclosure standards, and that is the intention. But that is the first pillar. Second pillar then is that, and which was perhaps a big surprise, that we announced that we will consolidate the sector so that major organizations in standards such as Climate Disclosure Standards Board and the Value Reporting Foundation will merge with IFRS. So we consolidate standards, we consolidate the organizations. And that is considered to be very, very helpful. Still work needs to be done, but we have agreed on the principles. Third issue is then that we also published some prototype requirements, especially climate. And the general disclosure prototype requirements are important so that people can start to prepare what they could be like. And of course, they are on the basis of work also when the ISB board goes forward. And they are now available for all. So decision to have ISSB, International Sustainability Standards Board, consolidation of the whole sector, and third publication of the two first standards were the main news, and they were very warmly received. So how do we move on now? What does this International Sustainability Standards Board do? Its task is to develop a global baseline of sustainability disclosure standards, and it should focus on the investor need. And it would enable companies to give comprehensive information on stability elements to the capital markets. And also in that area, there's possibility to work on its industry-specific way if needed. So that is the standard board. The second issue, consolidation. This consolidation was very important and very big surprise for many because, of course, when organizations grow, they have their own vested interest, very difficult to change. But this time we all agree that it's time to go for global standards and then the best home with this new organization has been ISSB. So such acronyms like Value Reporting Foundation, VRF, and CDSB, which means Climate Disclosure Standards Board, will merge with IFRS. And the third issue, as I already mentioned, is then the prototype requirements, which will be important steps when we go forward with the with our work. In the future, the architecture of ISP's requirements could be such that we have first, level of general requirements, and then we have themes, and then we have industry sectors. And we would start with the climate, as has been said. This commitment has been welcomed by various governments, and G20 countries gave welcomed the whole package when we came out. Perhaps I just finished to explain how these standards and European standards will coincide together. The idea is that we have today, first we have financial reporting standards which have investor focus, and they are reporting by tools of financial reporting. Now we go to a higher level. Above that, there's a sustainability related financial disclosure standards, and that means next step. So where sustainability related matters that may reasonably create or erode enterprise value over the short, medium, and long term will be reported. So normal financial reporting stays there, but then the sustainability reporting is broader, it goes above and beyond, and it's longer, works in the longer term. And then I just finished by saying that when it's all ready, the idea would be that we have on financial reporting, accounting reporting side area, we have international accounting standards, and their board, then IFRS accounting standards, which we are producing, and then financial statements, and then information cost to capital markets. Here on the sustainability side, we have the International Sustainability Standards MOS, which prepares the standards, which will be about disclosure, so how companies need to tell what they are doing. And then these disclosure standards give information to investors and markets, and then they have impact, of course, on the climate change work. But perhaps I finish here, and I leave you a chance to put any questions you'd like. Thank you. You are muted, Hans.
Okay, can you hear me now?
I hear you, yeah.
Okay, thank you very much, Erkki, for the very interesting and insightful update on the ISSB. So before we start with the questions, so I would like to welcome you very much in Frankfurt as well from my side. So as the Global Sustainable Finance Leader at Deloitte, and especially as a Frankfurt resident, I'm very pleased that the ISSB is such an important institution. Its global reach is coming to Frankfurt, and I can tell you we are fully committed, and we will do everything we can to give the ISSB a very good start in the Frankfurt Financial Center. So to the questions, Erkki. So I think there is no doubt that one of the biggest challenges is to translate strategic commitments into measurable near-term milestones and to measure financial emissions. And to face up these challenges, there has been a significant uptick in market and industry initiatives already focusing on converging climate reporting standards and improving comparability of climate-related metrics. We have, for example, as you know, released the Global Greenhouse Gas Accounting and Reporting Standard. In the EU, there is a Sustainable Finance Disclosure Regulation, and the Corporate Sustainability Reporting Directive will also amend the existing reporting requirements. So ISSB standards will be developed to facilitate compatibility with requirements that are jurisdiction-specific and industry initiatives focusing on climate reporting standards. So the question is, how can jurisdictions and international standards be reconciled from your perspective?
That is a very, very good question. Let's first start of the problem. And if we have a climate issue doesn't stop at the national borders or jurisdictional borders. It's global. So if we want to fight for against climate change, we need global cooperation. And it's especially so, of course, for private capital. The transition to carbon neutral world requires enormous amount of investments. Governments will not be able to do it. We need also private money. And I'm sure there are many who would like to do investment there, but they need to be able to compare those companies and their performance to whom they invest. And this is actually how the sustainability standards, disclosure standard would work. Those who want to invest, they can follow and analyze companies' performance. But then, of course, there are different ambitions, like Europe, Asia, America. Our idea is that we would like to have one baseline. So first we have international accounting standards or IFRS standards. Then we have higher sustainability standards, which include other factors, not only financial, but many factors will be impact of the enterprise value. But when, let's say, Europe has very high ambitions there and it's more advanced than the other continents, we hope that we can have one global baseline which we all agree about, because climate change is a global problem. But then Europe can, if so wish, to have additional requirements which go beyond. But they're like building blocks. They are one after the other. But the global baseline is critical, because if we don't have all countries involved and included, we lose a lot of the impact. On the other hand, also, capital markets are global. So that I think what are the global baseline factors is extremely important. But we don't want to, let's say that EU can't go further. But if we have the whole world is not there, then we lose a lot of impact.
Yes, I couldn't agree more. Yes, because we already are in contact with financial institutions in APEC and in the Americas, which are asking, what are you doing in Europe in order to give us a certain guideline? And if this will be incorporated into international standards, yes, which you are developing, I think this would be a very good starting point, of course, in order to get a comprehensive global baseline. Thank you very much for that answer.
Okay. Let me ask you and dig a little deeper. You are hoping to get a global agreement on that. How would you be able to attract the Asian side, in particular China, and on the other hand, Europe, the EU, and the US administration to get some definition?
First of all, in the IFRS, among the IFRS trustees, we have representatives from all continents. We have a strong representation from Asia. You know, we have people from China, Japan, India, Korea. So these are very important. So in our work, they are all involved. And that's first issue. Second issue is also that we have found that it's in the interest of Chinese companies to be part of the global system, because they are also working the global capital markets. And when the performance is measured, it's much clearer when they use the same standards as the other parts of the world. We have paid a lot of attention that our approach is inclusive, so all countries are there. And I'm happy to say that, let's say that the Asian countries have been actively participating in our process. And it's not only about how can we attract, but it must be also in their interest. And my reading today is that they see that would be very important. But it must be really this kind of global baseline for all, and this kind of building block approach, which would give sufficient diversity on the global solution.
I can't be more than agree with what you said. The impression and what I also have let's say, seen over the past couple of years, that Europe has really here, let me put it with a description, the nose in the wind, is leading ahead at the moment, fast followed by Americas, in particular the US and Canada, and Asia, in particular, you mentioned Korea, Japan, China, obviously, because also of its volume, but in Southeast Asia, if I have to mention one financial hub, Singapore. But they are all a little bit different setup and focus. Europe, I think, has the widest scale of the 17 SDG goals. As I said, then I would say definitely Americas, and then in a pretty narrow but very focused on green issues comes Asia. Do you feel that Asia is speeding up a little bit?
Just first to say that when international accounting standards are being drafted, of course we have global consultation, but our office is in London in one place. But these different sustainability disclosure standards, it's so sensitive. It is so many factors must be included that we have decided we must have a global footprint. And as a part of this global footprint, of course, Frankfurt is important because that will be a seat of the board. But also Montreal. Montreal will have the one major office which is responsible for America, and we are just preparing to take a decision also for Asia, third there, so that you must be globally present, that the organization can reply to questions, give information, and can also mobilize companies to go for the global standards. So this is very different from the other issues. A decentralized model is needed for this work. Can I just come back to this Frankfurt, because you mentioned that when we then announced the countries have a chance to make proposals of the cities where our activities could function, Frankfurt made a very, very carefully planned proposal, which included private sector, public sector resources, and they really have studied the issue profoundly. And when we came here last week, really, my people felt that there's strong commitment. Of course, still we have not done anything, but the preparation has very advanced, and it's very important now only to have two elements. First, to be able to start rapidly with the funding, and then to understand this is not a very, very long path. I mean, your item is that have we now found a path for international sustainability standards? Yes, there's now a path, but of course it takes time. I'm sure that for climate we start rather soon have the first standards, but there are many other issues which were on the agenda which take time to analyze properly, draft standards, but also with the support, because you need also support with standards. Thank you. Hans-Jürgen muted. Hans-Jürgen.
You're
not obviously I would be lost without you. so Erkki, I'm pretty sure that you received very positive feedback as when you announced the foundation of the ISSB, because as you said at the beginning, the market is demanding and investors are demanding, of course, global baselines and global standards. And now everybody is looking on the timing, yes, in terms of what is the ambition of the ISSB in order to establish first international standards, yes, because as we all know, it's quite difficult, of course, to work and to coordinate on global level. So is there already at you some objectives from a time perspective of the ISSB when you expect that there will be a certain standardized or a global standard which you could
Yes, I mean, this is a very important question. Our intention is that we would be able to have the first standard in the market in the end of next year. So now the prototype, which have been put to our website, is like the first draft has been done by technical experts on the basis of the climate recommendations, so-called TCFD, the TCFD recommendations. When they have done this work, that will be transferred to the new board when now chair and vice chairs will be nominated relatively soon. When this has been done, new board then can start the formal consultation of the paper, but I think there's really wish that we could publish the first standard in the end of next year. That would be very exceptional, because normally standardization and urgency don't walk hand in hand. Standardization is a very slow process, and urgency doesn't match there. But this time, the work ahead has been so strong that they could have this kind of running start, I hope.
Yeah, great to hear, because speed is essential, of course, in facing the climate change challenge. Yes, so thank you very much, Erkki, for the very interesting conversation. So we are looking forward to seeing you probably more often in Frankfurt next year. So
absolutely.
But for now, so we wish you Merry Christmas and a healthy New Year 2022, and looking forward to meet you in Frankfurt. Thank you very much.
Thank you very much.
Erkki, thank you very much. That was a great pleasure this morning. Allow me one final question before we continue our conference here. What can DZ Bank, Deloitte, or Malecki, or all the others based here in Frankfurt do to support you while you are starting to kick off the ISSB?
I think what most important is that you first yourself become very aware of the sustainability issues. You organize events with your client, give information to them that they are ready. Because I'm sure that in the future world, we have this kind of financial reporting on the one side and sustainability exposure on the other side. And they are complementary factors, kind of two sides of one coin, what the markets we want to know, investors want to know in the future. So sooner the companies start to work, they also more prepared they are. And of course, at the same time, prepare and the investors who then start to compare the information. You have a lot to work to, and we try to give as much information as we can, but of course you must do your analysis independently.
Erkki, thank you very much. You are invited for May, the second week, starting around the 11th of May for a 3-day conference in Berlin in a global format, together with our central bank, Deutsche Bundesbank, and KfW. We will are hosting our annual conference in Berlin, together with our contribution with our new government and European friends. You are more than welcome to give us an update what has been done and achieved in the first 5 months in 2022. Thank you very much. Merry Christmas, and stay safe, sound, and healthy.
Thank you. Thank you.
Ladies and gentlemen, what an interesting event so far. My name is Markus Pratsch. I'm Head of Sustainable Bonds and Finance at DZ Bank. I would now like to welcome you to our panel discussion, The Future of Sustainable Funding in Emerging Markets. Sustainable funding in emerging markets is on the rise. with forecasts that the emerging market green bond issuance alone could reach $100 billion a year by 2023, up from 40 billion in 2020. Investor interest in growing green, social sustainability and target-linked bonds from these regions is growing. I'm delighted now to have 4 experts on board to discuss the future of sustainable funding in emerging markets with me. Please welcome with me Nazira. She's head of Debt Capital Markets Eurasian Development Bank in Almaty. Please welcome with me Salina, General Manager of Capital Markets Malaysia in Kuala Lumpur. A very warm welcome to Parash. He's Senior Expert Bond Market Development, Public Debt Management Office, Ministry of Finance of Thailand in Bangkok. And last but not least, a very warm welcome to Domenico. He's Treasurer at the Asian Infrastructure Investment Bank in Beijing. So as a little warm up, Nazira, maybe could you briefly describe your organization's approach to sustainability and what role sustainable finance plays in your daily work? Okay, it seems that we have lost Nazira so far. So Salina, maybe we go to you first. Yeah, could you briefly describe your organization's approach to sustainability and what role does sustainable finance play in your daily work?
Okay, hi Marcus. Thank you so much for having me here today. I represent Capital Markets Malaysia. We're an affiliate of the Securities Commission Malaysia, which is the regulator for the capital market. So our primary role when we were set up was to position the Malaysian capital market. And given the fact that we have been a leader as a country in Islamic finance, that has been our main storyboard. But as early on as 2014, we realized how sustainable finance was starting to be very relevant in all the in the financial sectors, and the capital markets were starting to look at sustainable finance. We also started recognizing that there was an alignment between Islamic finance and sustainable finance in terms of the outcomes both principles were trying to achieve. So today what we do is we profile how Islamic finance plays a key role in sustainable finance in meeting the world's sustainable goals. But while we're doing that positioning, we also realized that we needed to build the depth and diversity and our track record as a country. So the way CMM plays a role in this is we started off by creating awareness and understanding of what sustainable finance means across the whole value chain in the financial sector. And then we realized that there was a key gap in the market, which you will find in other markets as well, whereby there's not sufficient technical expertise in this space. So we started developing capacity development programs for all stakeholders in the market. Now, what we are also trying to address is we're looking at governance structures and cultures in financial institutions and other stakeholders towards sustainability and how they treat things like climate risk and other key issues in sustainability. So that's in a very quick nutshell what we do.
Okay, thank you very much for this quick introduction. So Nazira is back. So yeah, Nazira, could you briefly describe your organization's approach to sustainability and what role does sustainable finance play in your everyday working life?
Thank you very much, Marcus, and sorry for being interrupted because of the connection. So a few words about our bank's investment activity in the ESG. So in our bank's investment activity, we are guided by the environmental and social responsibility policy. In accordance with the strategy for 2018 and 2022, we paid special attention to green financing projects, and in particular in renewable energy projects that must meet the criteria and requirements of the ESG. In 2020, the Council of the Bank approved the Renewable Energy Program for 2020 and 2024 with the volume of financing of up to $600 million for the implementation of renewable energy projects with a capacity of 500 megawatts. Until 2024, we plan to finance renewable energy projects for the amount of up to $1 billion. In the new bank strategy for 2022 and 2026, which was approved also by the EDB Council in July of this year. And ecology and resource and efficiency are declared as one of the priority areas of our business. So according to the new strategy, we also established a special department which is focused on the new ESG projects in the member countries where the bank is operating.
Okay, thank you very much for this overview. Parash, could you briefly describe, what role does sustainable finance play in your everyday life, and what is your organization or the Ministry of Thailand doing for this?
Thank you very much for the invitation to join this panel. So as a debt office, our main job is to raise funds for the government, mainly through the issuance of bonds. But recently, as we all know, I think climate change and social issues are important that we need to address. So our Director General, when she came in a couple of years ago, came in with a strong commitment to do more to help the government's efforts in meeting UN SDG goals or any other climate change goals, Paris Agreement. So we decided to issue our first sustainability bond, which includes green financing as well as the social project financing. It's been quite successful so far. The size has not gone over 100 billion Thai baht, with investors from local and offshore as well. And the other reason that we issued is not just because from our part, but we, as a government, I think it's a duty for us to do more to help raise awareness on this issue, to encourage other people, for example, state enterprise, private sector, to come in and help, issuing more this kind of bond. So going forward, I think it will be an integral part of our financing program now. So we have, of course, the conventional bonds, but the ESG bond will continue to grow to capture the growing market. We will explore other tenors as well, and even an offshore US dollar green is also in the pipeline. We already have the framework for that, so we are looking to issue and expand on this even further.
Okay, thank you very much for this quick introduction. Domenico, could you briefly describe AIIB's approach to sustainability and what role sustainable finance play in your everyday life?
Yes, Marcus, and hello, everyone. For AIIB, sustainability is really at the core of the mandate. We find these very words sustainable in the first of the articles of agreement establishing the bank. So we decided from the beginning to equip the bank with precise framework on our environmental and social policies, and all the lending that the bank is doing is done according to that ESF, that framework. On the back of that, earlier this year, we put together, and here is specifically in the treasury space for our investors, we put together the Sustainable Development Bond Framework for our debt issuance activity. This is a publication where we are summarizing everything that in the bank's mission and actions ties with the UN SDGs, basically. That's what we were referencing. And so in that regard, we decided to pursue a strategy that defines AIIB as a sustainable issuer rather than going the avenue of green or other thematic type of bonds. So we wanted to have an overarching strategy that covers as an umbrella all of our issuance activities in the market.
Okay, thank you very much. Maybe directly follow up to you, Domenico. I mean, given the nature of your business, why is labeling important? Wouldn't it be fair to say that every of your bonds is a kind of sustainable bond?
Yes, absolutely. And that is precisely the strategy that we have pursued. If you look up any of our bonds, on Bloomberg or any other service providers, you will see that they are labeled as sustainable bonds. And that's what we tried to impress in the market with our investors as our strategy. So all of the use of proceeds language in all our debt issuance programs is written in the same ways. So we don't have different avenues for directing our liquidity. All of the money that's raised by this bank is basically going to finance a sustainable deployment. And this is what the kind of narrative that we try to explain in the Sustainable Development Bond framework. And that's the way that we have defined all of our issuance. So if you look for under the ticker AIIB as an issuer, which is becoming more and more populated, you don't find any categories or classes of bonds. They're all the same thing. They all have the same use of proceeds language, and they are all issued under one program, which is our Sustainable Development Bond framework.
Okay, thank you. So let's dig a little bit deeper when it comes to frameworks and so on. And going back to Nazira. Nazira, you have recently published your Green and Social Debut Instrument Framework. And could you elaborate a little bit on this?
Sure, thank you. Yes, the framework or the policy on the issuance of green and social debt instruments was approved by the authority of the bank in August of this year or September. Yeah, and the purpose of this framework is, of course, to get the special funds from the investors that put these funds into our green and social bonds, social projects. And according to this framework, we have a special procedure according to which we select and approve green and social projects in accordance with the ICMA criteria and principles, and also based on the international and national standards and taxonomies. As you may know, the bank is operating in 6 member countries, and we have the only 2 of which have approved taxonomies on ESG. So we select and approve the projects in these 2 types of national taxonomies. We also made a historical analysis of our loan portfolio, according to which we finalize 3 types of green projects and 2 types of social projects. So when we understand the green projects, we assume that these projects are renewable energy projects, energy efficiency projects, and sustainable water and wastewater management projects. On social projects, we understand the projects that are creating affordable basic infrastructure in the member countries, and the assistance to the working age population and programs. So this document is quite a new one for us, as we are the younger of the multilateral institution in the region, but we are taking all best ESG practices in the world and put them in our experience. So this framework is not just a standard. We can make some changes if we see a particular interest from the areas where we work, and if we extend the type of green and social projects in our member countries.
Okay, thank you very much. Yeah, looking a little bit at Thailand, Parash, you already elaborated about the successful maidens issuers. How about your framework? Which are the eligible categories which were used for the maidens issue? And of course, prior to the issue, it's very important to engage all the relevant stakeholders critical for success. How did you handle this, and who was involved?
Yeah, I think the first thing we thought of when we were doing our framework was to make sure that this bond meet all the standards, IGMA, ASEAN standards. And we had a lot of help. We engage ADB, we engage the World Bank, and also the banks that have as lead arrangers for us. So we looked at a lot of sovereign country framework and took the best practice from them. And we got our framework a second party opinion by Sustainalytics. And also, we had to include all the categories that is important in our framework. So when we look at our category for green and social projects, obviously, it's a global effort in helping climate change, but we also decided on things that are specific to Thailand. As you know, we are a country that sits in a place where we are prone to many droughts, floods, and severe weather patterns. So a lot of people actually live in the rural areas, lower income areas, and agriculture and tourism is the main part of the economy. So we include everything from mass transit, electric trains, water management, natural resources, on the coast as well to promote green tourism. And also for the social projects, anything from employment generation, including access to affordable housing, water, public utilities. So and we think that those are important for Thailand, but for the first issuance, we only did it for COVID financing for social and the green electric train. Other parts of the framework, very important to have a committee set up, because that's a challenge for government. We have hundreds of agencies doing different things, so it's important to have a body that includes people with different expertise, from project selection, people who look after the money, making sure it goes to the right place, not to the wrong projects, and people from the market as well, SEC and the Bond Market Association, because they've done a lot of good work on that. So this body will be important going forward to get a stronger collaboration across agencies. And then again, we do a regular reporting every year. The report actually external review as well by another party. So we have a lot of importance on transparency, and just to make sure that investors are confident that we are, putting the money in the right place and not into the wrong things, and going against all the things that we need to do.
Okay, thank you. So collaboration is a good buzzword. Salina, in 2020, Capital Markets Malaysia has launched the Malaysian Sustainable Finance Initiative to support the Malaysian financial sector and further embracing the tenets of sustainable financing. Could you elaborate a little bit on this, and who are the members? Which are the key activities?
Okay, so Marcus, the reason why we set up MSFI as the acronym for it, it was in 2018, 2019, we set up a task force on seeing what were the structural changes that were affecting or sort of limiting the flow of finance towards renewable energy. And that was where Malaysia started its journey in terms of sustainable finance. And we realized, given the way Malaysia is structured, we needed financing from different segments of the financial sector, not only the capital market, but also the banking side. And within the banking side, we had different sizes of organizations that needed funding, not only the larger organizations, but the SMEs as well, which make up a significant part of the Malaysia's economy. So we set up the MSFI, which is a collaboration between government, the regulators, and industry associations across the financial sector. So we're talking about the insurance, banking, investment banking, digital platforms, that's your crowdfunding, ECF and P2P platforms. And we've also included private markets, because there's certain kinds of new technologies and new industries that are coming about with this new sustainable economy development, that you can't expect the traditional financing structures to fund that. So we collectively brought in the private markets as well, so that we could build sort of technical expertise across the financial center. And so besides the membership, so what we focus on and prioritize is product innovation. So we look at what are the sustainable projects in Malaysia, what kind of funding is needed, what are the size of funding is required, and then we break it down according to the various segments and we see what kind of role they play. And what's been interesting is since we set it up, I mean, the traditional segments that always tend to sort of as a fallback is the traditional banking. And you, of course, have the investment bankers who look at bonds and sukuk issuances. But what we've been seeing traction in the last 12 months is we've seen the private market guys, the VCs and PEs, are sort of stepping up in terms of their sustainable investments. And we're getting a lot of our SMEs who are part of the global value chain wanting to raise finance sustainably for their sustainable projects. So we have seen 1 or 2 campaigns on our ECF platforms as well. So we found that exciting. So one of the ways we try to encourage this is we bring in best practices from other jurisdictions, you know, the other developed markets where all these things have been sort of put in place at least 24 months before us. And so we try to learn from these other markets in terms of how do you handle the risk? How do you reach out to investors? How do you make sure the disclosure standards are appropriate? How do you make sure that the investment principles that are taken into account are appropriate? And so those are the kinds of things that we try to address in our training, Marcus. I hope that helps.
Okay, thank you very much. We've talked already this morning about, you know, very dark green things, but of course, transition somehow is key. So we can have a much bigger impact on the global sustainability agenda if we help to make, let's say, brown activities light brown or light green instead of painting already dark green things a little bit greener at the end of the day. Domenico, how does AIIB support this just transition?
Marcus, the transition discussion is a big one, and it's a very important theme. We do have an energy strategy here at the bank that clearly sets the areas of interest and the objectives and what the bank is going to do in this area. And we are going to update this strategy this year. And I think that's going to be a key discussion to address in particular the transition issue. I think we are very key in this debate because we are placed in a region which I think is going to be probably the most important on the planet for the transition dynamics. So how do you intervene in a region that has already some type of infrastructure that's heavily reliant, in particular in the energy sector, on fossil fuels, and how do you make it clean or cleaner? And I think that's going to be one of the major discussions to be had. So the energy strategy, the update, we unfortunately don't have yet, but we have taken some steps. For example, in particular, we do have some projects where we have financed, for example, downstream usage of natural gas. And this is, for example, a discussion that can elicit different reactions when you are talking about ESG. However, for example, if you look at some of the projects that we have had one very recently here in China, in the Hebei province and the Beijing and Tianjin metropolitan areas, to supply natural gas to a large number of families which were previously supplied through coal-fired plants. Again, typical transition discussion to be had, and I think it's going to be very important that policymakers, that MDBs, investors do agree on the stance they are going to take on this super important topic. You have two of the largest economies, largest countries in this region, in India and China, who are still heavily reliant on coal as a source for power. Again, how are you going to make that? How are you going to help on this front. And this is a problem that I think if you tackle it in Asia, it's we are trying to play our part. Again, the update of our energy strategy definitely is going to look into this area. We have acted, for example, through our president, who has made a public pledge of the bank not to finance any project related to coal and other measures in this space. But again, I think it's a super important debate that I don't think it's over yet globally.
Okay, thank you very much for this very interesting points. Going back to Nazira, I mean, you've already mentioned that you have recently issued a social bond. Maybe you could also elaborate a little bit about the use of proceeds categories, and also looking forward a little bit. ESG projects currently make up 15% of your portfolio. Most of these projects are still located in Kazakhstan. How will this portfolio develop in the future?
Thank you, Marcus. This year, we actually did two types of sustainable bonds. Yeah, the first one was a green bonds and also denominated in Kazakhstani tenge, and this issuance was done in September, and for the total amount of 20 billion tenge. After that, we decided to issue a different type of bonds, like social bonds, also for 20 billion tenge. So the total amount of these two issues was 40 billion Kazakhstani tenge, which is about $90 million. When we talk about the use of proceeds, of course, we can use these funds only for financing the projects approved and selected in accordance with the framework. And both of these issues have been verified by the independent company. And the use of proceeds on the green bond from the green bond issuance was used to finance our energy efficiency projects, the construction of solar and wind energy farms in Kazakhstan. And the social bonds, the proceeds from the social bonds were used for financing our social programs, like the financing of microfinance companies, financial institutions, with the purpose of financing SME, small and medium enterprises. And we also, part of these proceeds were used to finance the transport infrastructure facilities that have a positive social and economic impact on creating areas, on the certain areas by creating jobs. So yes, you're absolutely right. Currently, our loan portfolio and the sustainability projects is something about 15%. Yeah, and according to the energy efficiency program of our bank, we, as I said in the beginning, we are going to extend the type of these loans and to increase it up to 25% of the loan portfolio within the new strategy. And until 2024, we believe that the total amount of our green projects will, especially energy efficiency projects, will increase up to $1 billion.
Okay, thank you very much. So, Parash, back to you. Which are the biggest challenges when it comes to sustainable funding, and maybe also a look in the glass ball for the future? Which will be the next step for your sustainable funding agenda?
I think for government, I think I mentioned earlier, I think just getting the cross agencies to work stronger together. I think that's one challenge. I mean, it's not like a corporate where you have everything under one roof. So in terms of the process, I think that takes a bit more time. And I think, for government, I think we have a lot of law and regulations, in terms of, borrowing for which objectives. So we are trying to sort of streamline that more so we can get more projects involved. And so we are reaching to other line ministries, outside that we haven't done before. For example, the first project was mass transit. So we are trying to expand to other sectors like energy and in particular the preservation of coastal areas. I think we want to keep the tourism spots for as sustainable as possible. So I think that's in terms of projects, I think that's what we are working towards. So we are meeting with them regularly and just trying to find a sizable and appropriate project for that. In terms of the issuance side, the 15-year tenor that we issued already will continue to be built because we want to make sure that we have liquidity for the investors, to come in, buy and sell. And also, I think, expanding to other tenors, building the curve for the green yield curve. And also, I think the dollar market, obviously, I think very, very attractive for us. A huge market. And I think the investors, I think, recently have a mandate to invest into ESG as well. So it's a growing market. And it makes a lot of sense from debt issuance side and also the project as well.
Okay, thank you very much. So a very bright future for sustainable funding. Coming back to Salina, Islamic finance, you already mentioned it, and sustainable finance. This is a perfect fit. How do Islamic finance principles interact with the conventional sustainable finance? And also looking at the construction of the sukuk. I mean, Malaysia's first green sukuk was issued already in 2017. Which role will sukuks play on the future sustainable funding agenda? Are there any incentives for issuers? And how do you see the potential of sustainability-linked financing in this context?
Okay, hi Marcus. That's a lot of small questions and a big question. Okay, let me try to sort of get all your answers out for you. So in terms of the alignment of Islamic finance and sustainable finance, I think it's the underlying principles in terms of what are the outcomes we want to achieve. In Islam, I think the main outcome, the main principle that underlies everything is the principle of doing no harm. And I think sustainable finance fundamentally is addressing that issue. We've shifted as the world has moved along in terms of what are priorities. So we've looked at corporate governance, and that has been something governance has been important. And now we see that environment has become a critical area for us to address, and we're now addressing social issues as well. So if you look at that, sustainable finance and Islamic finance is very much aligned in that sense. In terms of going down to the sukuk product, which is equivalent to the bond product, we started off as an affiliate of the regulator. I can tell you from a regulator's point of view, we started off recognizing the need for green projects, and we came up with a framework that sort of highlighted what were the green projects that one could use a sukuk instrument. And we came up with a framework for that as early as 2014. But because of the lack of understanding and lack of technical expertise, I think we only saw the first issuance in 2017. But green fundamentally only talks about renewable energy, renewable project, sort of green buildings and stuff like that. But now what we've done is we've expanded. Sukuk is now being used, this kind of sukuks that you see coming out in Malaysia are sustainable sukuks, whereby we're addressing social issues, we're addressing projects that are not so green anymore. And I think that's where we're sort of segueing into transition financing. What I think as a country we're recognizing, and as a regulator we're recognizing, is that the use of proceeds method that addresses green projects will not address our global challenge of meeting our carbon emissions targets for 2030 or 2050. We need to go beyond green, and we need to start transitioning the brown economies to become more sustainable. And therefore, that's the regulator is now looking at regulatory frameworks to enable sustainability-linked sukuks, which doesn't use the use of proceeds method, but looks at an issuer's sort of sustainability strategy going forward and how they will meet certain goals and targets they set in place. So the challenge for us is, how do you ensure or limit the chances of greenwashing? And therefore, how effective should the disclosure regime be? So these are kind of things that, from a regulator point of view, that we are trying to address. And we feel that the sukuk is a natural instrument that can be used and invested by not only Muslim investors, but we think that conventional investors that are looking for exposure in this side of the world, where Islamic finance is predominantly well recognized and its financing instruments are used significantly, that even conventional investors can start looking at sustainable sukuks as an investment opportunity into this region.
Okay, thank you very much. Very interesting. Domenico, coming back to you, your mission, you already mentioned, is infrastructure for tomorrow. So what are emerging infrastructure trends?
Yes, Marcus. Well, first of all, let me say that I could not agree more strongly with what Salina just said. All the things that she said, supporting sukuk issuance and the doing no harm and moving into the social, some of the social areas. These are things that resonate very highly here. And just to give you an example, along with what Salina mentioned of looking at ESG not only as financing purely narrowly green infrastructure. During the COVID pandemic, at the height of the pandemic, we found that we basically had to almost suspend everything that we are doing. The world shut down, inability to travel, impossible to go and design or supervise projects. Very difficult. We still kept it going, but it was very difficult to build new business. A lot of clients came to us for other types of assistance, rapid response to the pandemic, reinforcing their pandemic prevention and analysis and machinery, many other similar things. And so we reacted very quickly, and our president was very strongly of this opinion that we should set up a new dedicated department in the bank, which is now up and running, and it's in social and healthcare infrastructure. So we still call that infrastructure. And this goes exactly to the points that Zalina was mentioning just a moment ago. So it's kind of a different or new approach to looking at all these, the mandate of financing infrastructure and how you look at ESG issues. In the corporate strategy of the bank, which covers the 2020 to 2030 decade, we called all of this infrastructure for tomorrow. And it's just a way to say that we want to look at this with slightly different eyes and the different types of business that it's normally done in the development space. So this bank, AIB, does have some ambitions. First of all, and again, it's similar to what Salina mentioned, how to involve the private sector and how to look at the private sector, not only as recipient of finance, and we want to do that. For example, AIB has a target and an ambition to finance a quite higher share of private sector projects than a typical MDB would have. So we are new. Again, we are yet to prove if that's possible, but we do have an ambition to grow the share of financing in private sector up to 50% of the volume of the financing that we issue. And this will be in 2030. It's very high, very ambitious. So we're going to try. And then we also would like to find a different way of doing this type of development business. So a lot of emphasis on technology, digital transformation, ways of attracting also private sector money, private capital into our projects. And so we are doing this very quite often by participating, for example, in financing platforms or new ways to unlock capital and ways to attract also private sector capital along ourselves. And so these are the things that we would like to add to the typical development component of our sector, the business sector that we are in. And again, we are a young bank. It's rather new, only 6 years has been around. And so many of these things are we aspire to do, and we are trying to just set up at the moment. But that's the way that we look at this under this tag of infrastructure for tomorrow.
Thank you, Domenico. So looking at the time, we are nearly at the end already. One last question I received from the audience via LinkedIn. I asked via LinkedIn to give in some questions. You know, the European Union is currently working for a common language of sustainability with the so-called EU taxonomy. Very short in a nutshell, maybe with 1 or 2 sentences from everyone. How much regulation and standardization do we really need in this market? Or has sustainability also something to do with, let's say, cultural differences and regional differences? So would this kind of standardization really help, or will it more or less be an obstacle for the market? So very quickly, starting with Nazira, please.
Marcus, I think it's a very good question for everyone. As far we have, the bank is operating mainly in Russia and in Kazakhstan. I would say that these 2 countries are already prepared to the international standards. As far they also declared and approved their own taxonomies. And we hope that the implementation of these taxonomies would be good. And we are being the multilateral institution and operating in this region. We, of course, would be keen to support the ideas that are stipulated by the international society. And this was declared during the conference of our bank that been just recently passed, and we think that the society in our member countries now do understand what can happen if we couldn't achieve the ideas and the purposes that are stipulated by the international national taxonomies. And we do believe and we hope to support the ESG direction in the member countries of our bank.
Okay, thank you. Selina, what's your opinion on this?
I think the call for standardization, I think, has merits. If you look at the financial reporting, we all use a standardized approach to financial reporting, and that has got us far collectively as a world. And I think the corporates, issuers struggle with lack of standardization. I think the general feedback you have is they have multiple standards they have to disclose to, and they spend 3/4 of their time reporting them rather than running their business. So there is an advantage of standardization. But again, my personal opinion is it is challenging to standardize a taxonomy for different countries that have different economic structures, different challenges. And so to come up with a standardized taxonomy, I mean, it could become too rigid, or it could become not wide enough to encompass all activities. And then it could be self-defeating in itself. No yes or no answer, but I think there's a debate for and debate against, in my opinion.
Okay, thank you. We have only 1 minute left, so very quickly, Parash and Domenico, how do you see this issue?
Just very simple for me. I think some standard is needed, but hope it's not too much to discourage people from issuing more. I know from working with other SOEs, other corporates, they already struggle with the extra. It's more costly, it's more time consuming to come in. So we don't really want any regulation to discourage them. I think at this time, I think we just need people to do as much as they can with what they've got, to help issue the climate change and growing social injustice. So I think so, not too much to discourage people.
Okay, thank you. Domenico, final words for today?
Yeah, in a couple of words, very much agree with that. This is something that cannot be done overnight, although it's urgent. And just look at COP26 and how difficult it is to get an agreement done. So in my view, simplicity is the key to standardize. And there should be few principles, very clear, that can cover multiple jurisdictions. And so they do not have to create segmentation in the market. So this is because we know that this is going to be a process that, although urgent, is going to last for quite some time. And so you have to be able to invite, the market to converge to certain standards.
Okay, thank you very much. So thank you very much to all the participants, a very interesting discussion. And now I wish everyone a nice conference. There are still some very interesting topics on the agenda. So enjoy, take care, and stay healthy. Thank you very much.
Thank you.
Thank you.
Good morning, everybody on the screens, wherever you are on this beautiful planet. My name is Robert Koller, and I am the CEO and founder of the European Primary Placement Facility, the only fully digital end-to-end and regulated primary issuance platform and primary market for financial instruments. I have the great pleasure to moderate the next panel, but before that, I'm delighted to be able to introduce the next keynote by Hassatu Diop Nzele, Treasurer of the African Development Bank Group, who will speak about an African vision for sustainable finance in the face of climate change. I'm extremely curious, and therefore, without further ado, over to you, Hassatu.
Thank you very, very much, distinguished guests. A warm welcome to you, and a very big thank to you, the organizer, DZ Bank, for inviting the African Development Bank to participate in this very important discussion. And I'm extremely delighted and grateful for the opportunity you have given me to speak on this to this very important audience today on this very important subject. So my name is Hassatu Nzele. I'm the acting Vice President Finance and CFO of the African Development Bank, and also the Group Treasurer. So it is an undeniable fact that the climate is changing and having a devastating impact on Africa and the whole world, while with life becoming more and more unbearable for millions on the continent. The combined effect of periodic droughts, floods, cyclones, and climate-induced swarms of locusts are devastating farmlands, increasing food insecurity, and destroying the livelihood of smallholder farmers, the majority of whom are women. In total, it is estimated that Africa loses between $7 billion to $1 billion a year due to the negative effects of climate change. And this could rise up to $50 billion a year by 2040. So we simply have no choice but but to rapidly adapt to this changing environment. So despite being a disproportionately low contributor to GHG, compared to the most industrialized nations, low-income countries in general face a much larger exposure to climate change risk. And in the case of Africa, the continent has very little in terms of the resources necessary to adapt to climate change. And so moreover, the impact of the COVID-19 pandemic has contributed to the first recession on the continent in 25 years. And these have threatened to reverse many of the key development gains achieved over the last decade, and pushing an estimated 39 million people into extreme poverty in 2021 alone. So with the world, while the world needs 1 to 2 trillion a year for the next 30 years to tackle climate change, Africa will need about 335 billion by 2030 to implement its climate adaptation and mitigation actions, reflected in the nationally determined contribution, the NDCs. And of this, 20% will be expected from country resources, while 80% will need to come from the developed partners. So hence, the developed world must meet its commitment of providing $100 billion per year for climate financing, as this will go a long way in helping countries fulfill their NDCs. So otherwise, if the financial risk emanating from COVID-19 and the climate threats are not properly identified and managed, they will pose a significant systemic threat to the stability of the financial systems, with disastrous spillover effects on key real sectors of the economy, particularly agriculture, infrastructure, and energy. The African Development Bank has for a while now been championing several innovative initiatives for scaling up climate investment and accelerating the transition of the continent to a low carbon and sustainable future. And as the continent's premier financial institution, the bank must play a central role in Africa's transition to a low carbon economy, low carbon pathway, including providing support for the preparation of and implementation of transition plans and what we call the just energy transition, as well as development of renewables and other green technologies. So the African Development Bank has pledged, for example, to double its climate finance, allocated $25 billion of climate finance between 2020 and 2025. And we will mobilize $12.5 billion by 2025 for the Africa Adaptation Acceleration Program, the AAAP, and in partnership with the Global Center on Adaptation. So that program, the AAAP, will consequently scale adaptation solutions across all African countries and will build upon what is working and speed up the actualization of the Africa Adaptation Initiative of the African Union. So the bank has also launched a $20 billion Desert to Power initiative, one of our flagship projects. And the idea is to develop 10,000 megawatt of solar in the Sahel region, which is a band that crosses from the east to the west part of the continent, the middle band of the continent. And Desert to Power is expected to provide access to electricity to 250 million people. And when completed, it's going to be the world's largest solar zone. And at the recently ended COP26 summit, we were pleased to announce a $150 million commitment for the Desert to Power initiative by the Green Climate Fund, which brings us much closer to the goal of realizing these highly transformative projects. So ladies and gentlemen, it is worth highlighting that the Global Climate Finance Landscape report by the Climate Policy Initiative showed that whereas the global climate finance has recently increased steadily, moving from $365 billion in 2013-2014 to $579 billion in 2017-18, Africa, which bears the brunt to climate change impacts, only receives a mere 3% of the global climate finance, 3%. And moreover, the climate finance is heavily skewed in favor of mitigation, 90% actually. Yet, adaptation is Africa's priority. So this is why the bank has been prioritizing adaptation action plan, and it has increased adaptation finance to $2 billion in 2019, increasing the proportion of adaptation finance to 55% of its approval. And we have actually become the only multilateral development bank to have achieved and indeed exceeded the recommended parity between adaptation and mitigation. And this is an achievement that was duly recognized by the UN Secretary General at the General Assembly, who called on others to emulate the work the bank is doing in that regard. So 80% of our climate finance resources are coming from our own internal financing instruments, with the balance provided by co-financiers and external climate finance providers, such as the Green Climate Fund, GCF, the Global Environment Facility, and the Climate Investment Funds. So with already heavily constrained public balance sheet and high debt to GDP ratios in many African economies, mainly driven by the economic fallout from the pandemic and recent growth stagnation, there is a limit to what the public sector can do alone. And therefore, the role of the private sector in mobilizing climate finance for Africa has therefore become very, very critical. And actually up to 75% of investments into Africa's NDCs will be expected to come from private capital, and it's through global coalitions such as the UN-convened Net Zero Asset Owners Alliance, representing over 6.6 trillion of assets under management, that will help bolster sustainable development. So there is a growing universe of ESG investors that will also play a significant role in this regard. And the bank is mobilizing sizable portion of its borrowing program for such investors. So to help tap into this growing pool of assets, the African Development Bank and others actually have set up borrowing programs, green borrowing programs, and social bond programs. And there are also additional mechanisms that can be mobilized for climate resilience. And one of them is the IMF 650 billion issuance of special drawing rights, being the largest in history, but also which has been touted as an instrument to foster the resilience and stability of the global economy by helping vulnerable countries to cope with the effects of the pandemic. So this SDR allocation presents a unique and timely opportunity to provide SDRs to MDBs who can leverage these assets 3 to 4 times and thereby deliver higher volumes of financing to African countries. So innovative financing mechanism will also go a long way to further unlock investment, such as the various that we are involved in various co-financing activities, and with bilateral donors, which is going to help this agenda move forward. So we have been lending in the multilateral space with the optimization of our balance sheet to raise more for climate finance, and that's another way of bringing the private sector into climate finance. And you might know that during the COP26 summit, the UK government announced $2 billion in guarantees to the African Development Bank, which will allow us to deploy greater climate financing for Africa in the years ahead, once the mechanism is fully in place, with the resources expected to be split between adaptation and resilience. So there is one instrument that is called the Africa Disaster Risk Finance Initiative, which is jointly implemented with the African Risk Capacity, and it aims to ensure that African countries are insured against climate change-related disasters and build resilience. And the program is expected to mobilize about $250 million for insurance premiums, with a potential payout of $1 billion from the reinsurance market by 2030. So you see, we need to bring as many actors to these initiatives as we can. So the adaptation benefits mechanism, which is a first-of-a-kind results-based payments mechanism, creates an incentive for private sector action and finance for enhanced resilience of vulnerable communities and ecosystem. So this mechanism will also be an important channel for creating supply and demand for climate bonds and green banking. So through partnerships and co-financing more broadly with other MDBs, bilateral agencies and philanthropical organizations, our combined efforts can do a lot to contribute to critical areas such as project preparation, which is something that is important for the African context. The risk mitigation, because of the very high perception of risks that we see on the continent, which is not necessarily correlated to its realities. And risk transfer instrument, blended finance, and other equity to support private sector projects. So de-risking and creating opportunities to mobilize much larger actors is the path forward. As I conclude, so let me reiterate that the challenges that we all face are enormous. The challenges that Africa faces are formidable, but so are the opportunities. The African Development Bank continues to look for international partnerships with prominent public and private sector organizations to help scale up many of the existing initiatives, including creating new ones and making them work for Africa. So together, we will be able to shift from billions to trillions of dollars in development financing. And this is a joint effort we will need to save our planet and advance the global green growth agenda. And we look forward to working with many of you represented here today in realizing these critical development ambitions going forward. So let me thank you for your kind attention and wish you fruitful deliberation in the rest of the days of the programs. Thank you very much.
Thank you very much, Hassatu, for this immensely interesting presentation from an African perspective. Now it is a great pleasure to introduce you, after the best keynote of the day, the best panel of the day, which is guaranteed as interesting as the previous ones, and if I dare to say so, even more. I'm delighted to have here with me on the screens so distinguished representatives and practitioners from all over the globe that we will share the knowledge about all things insurance-linked securities. And the first panelist is Robert Aguiarco, lead advisor of outbreaks and epidemics of the African Risk Capacity. My name is Robert Koller. I'm the CEO of EPPF, the European Primary Placement Facility. We have also on the panel Henning Ludors, Managing Director of Retrocessions Capital Markets, Hannover Re. Eduardo Marino, Deputy Treasurer, Bureau of Treasury in Manila. Andy Palmer, Head of Insurance-Linked Securities, EMEA and APAC of Swiss Re. And Michael Roth, Senior Manager, Public Sector Business of Munich Re. As you can see, we have distinguished guests from all over the globe. And I would ask all of you to maybe briefly introduce yourself and what you do to our audience. And will you give you my first question along the way? Could you please share some views on the refocus of sovereign risk financing strategies in the light of COVID and climate change? Maybe we go in alphabetic order as before and start with Robert, please.
Thank you very much, Robert. I'm the lead advisor for disease outbreaks and epidemics for the African Risk Capacity based in South Africa. My background is in global public health and development. I have about 25 years of experience in development and public health, and I'm pleased to be part of this session. Thank you.
Maybe you can also give your view on the first question about the refocus of sovereign risk financing strategies in the light of COVID and climate change.
Okay. Thank you. Right. So I think COVID, for those of us who work in the public health space, COVID has shown the importance of ensuring public health emergency.
Okay, I think we lost Robert. Then Maybe Henning, you can continue with the introduction and answering the first question. You unmute.
I apologize. So I start again. My name is Henning Ludolf. I'm with the Hanover Re. And I have two divisions. So one is an ILS division where we support clients to transfer their risk to capital markets. This could be in catastrophe bond or collateralized reinsurance form. And the second one is the division who buys protection to protect the Hanover Re group. And this we also do substantially from capital markets. On the topic of countries and their involvement in ILS, we have quite a bit of involvement in observing how countries and years, this will become one more. Robert, this is a very short comment, or you want me to go on? Probably can go more into details, but maybe we should not speak too long.
I think a short introduction like this is fine. Thank you very much, Henning. Next in line, Eduardo, maybe short presentation about yourself and what you do and your view on sovereign risk financing strategies.
So, good morning, everyone. So I'm Ed Marino. As mentioned, I'm the Deputy Treasurer for the Bureau of the Treasury. So that's the National Treasury of the Philippine government, of course, stationed here in Manila. And my coverage, to be precise, is asset management, research, and accounting. Now, in terms of the reason why I'm here is because well, I was involved when we were conceptualizing about a decade ago regarding the Philippines disaster risk financing insurance and strategy, and of course the early conceptualization, and of course the final placement of the risk transfer instruments that we have done over the past few years. So the parametric insurance in 2017 and 18, as well as the catastrophe bond back in 2019. Now, the motivation actually for those initiatives was that there was, just a decade ago, we already identified the need to diversify our funding sources. So for the longest time, the Philippine government has just relied on budgetary resources to handle, impacts of disaster. But with the impending climate change, the impacts of climate change, the Philippines will be one of the most affected countries of climate change. So there was, if we do not change things up, we do not find alternative funding sources, we would be having problems, fiscal problems, handling the enormous damage that climate change can cause through the stronger typhoons and more disasters, so to speak. So that was the motivation, so that to go into and explore financing structures like the parametric insurance and the catastrophe bonds. So right now the team is thinking of how we can best respond how we can respond much more efficiently when another, let's say, hopefully not, but when another pandemic hits. So that's the current discussions, internal discussions going on. Thank you.
Thank you very much, Eduardo. Andy, your introduction and view, please.
Yes, good morning. So Andy Palmer, I'm the head of ILS structuring across the EMEA and APAC regions within Swiss Re, who, similar to the likes of Munich and Hanover, of course, are one of the world's largest reinsurers. I work within the Alternative Capital Partners division, so this is responsible for the transfer of insurance and reinsurance risks to to the capital markets, both for Swiss Re itself and also for our clients. And here, I think it's important to note that one of the type of clients we are responsible for is, of course, governmental clients. And Swiss Re Capital Markets has been a leader in arranging catastrophe bonds on behalf of different governments. So, for example, for the likes of Philippines, also Mexico and the other Pacific Alliance countries, and most recently we arranged a transaction on behalf of Jamaica. Now, to your question, Robert. Increasingly through our public sector solutions division, we have had more and more discussions around the management, if you like, of disaster risk, be it for pandemic, be it in relation to more climate-linked perils, such as windstorms and things like that, but actually even broader than that. So it goes beyond to other types of catastrophes as well. And I think the healthy discussion that is being had increasingly is the awareness of risk and the quantification of risk, which wasn't always happening in the past. And sadly, events like COVID drive those kind of discussions, and it's only after the events that those discussions seem to happen. But it's very pleasing to see now that those discussions are happening at very serious levels around the world as to how to manage those risks going forward.
Thank you very much, Andy. Last but not least for this round, Michael, your view and introduction, please.
Okay. Hello. Okay, not anymore good morning for some of you, but it's a pleasure for me actually to be invited actually to this distinguished panel. So my name is Michael, and I'm the so-called public sector practice lead for Munich Re's division of non-traditional risk transfer. The unit is called also Capital Partners. I have the task to push on behalf of Munich Re the frontiers of insurance actually to new types of risk geographies and client groups. So certainly primarily actually public sector entities. So as Swiss Re and some others, actually, we regard ourselves as actually in a leading position with regards to ILS solutions or other type of risk transfer solutions for sovereigns, also actually very much focusing not only on sovereigns, public sector entities, but also on novel and complex risk and risk solution structures. So having said this, like in our public sector practice, we look beyond ILS solutions also into parametric derivatives, insurance, topics such as resilience bonds, impact bonds, but we also drive novel developments such as the inclusion of disaster insurance clauses in sovereign bond issuances. So I think that COVID, as you were asking for it, certainly revealed that there's a huge protection gap, of entire economies across the globe. And I think the COVID shock to some extent triggered a real broad discussion on ex-ante financing needs actually to address future disasters. So not only epidemics or pandemic in nature, but also actually focusing the view on other types of disasters, more actually climate change related, and or possibly also cyber risk as a huge risk with disaster potential inside. So given actually the wake-up call of COVID, I really expect a new dynamic of interest from public sector entities in financial instruments such as cat bonds actually to protect themselves better against catastrophic risk.
Thank you very much, Michael. Thank you all for this interesting overview. I think there's tons of things to pick on. Maybe let's start with Henning and back to basics. Maybe you could give us a bit more of a deep dive on government-linked catastrophe or disaster finance bond, how they typically function, motivation benefits for governments, bond form versus other forms, and what about man-made risk? Is there a moral hazard? Michael just mentioned cyber risk.
Yeah, moral hazard is probably a good point because the risk financing strategies are usually based on parameters, for example, also to avoid model risk. Well, let's come to the basic principles, either in bond form or in other derivative form. In fact, the idea is to enhance resilience and protect against extreme weather and natural disasters. And this is done by using a parameter or an index, which makes it fairly easy. Let me give an example, which is an illustrative one, but Mexico, besides Jamaica and Philippines, have been one of those issuing a lot of bonds. Let's say there is a contract if an earthquake happens near to Mexico City, which has to be defined, of course, with a magnitude of 7.5 or higher, then there's a payment of $200 million. So it's very easy to determine whether there is a loss or not. There's not the necessity for people to go out and evaluate damage and to evaluate how costly the disaster has been. It's simply to check, has there been an earthquake close enough to Mexico and has it been big enough? And I would say basically all risk financing strategies work on this basis, whether in cat or a different form. The big advantage for a country like Mexico or Philippines or Jamaica is that the payout of money can happen fairly quickly. You don't have to make long judgments of what has been destroyed. You only have to check is the parameter been triggered or not. And this will then help governments or semi-government institutions or regional governments to use money for first aid, to help the uninsured, even to fill tax holes. If factories are destroyed, they can't produce, they can't pay taxes, so there will be tax holes. It avoids budget reallocation of funds within the government, and usually governments do not have excessive cash, they are always short on cash. Of course, infrastructure has to be rebuilt. And last but not least, it protects the sovereign rating as well. Rating agencies will look at these risk measurement actions taken by governments and will help to either improve or stabilize the sovereign ratings. Needless to say that in addition, it also stimulates risk mitigating features, which again in turn will over the long term help the countries to reduce maybe cost for insurance reinsurance. Now, you mentioned moral risk. Now, I don't think an insurance entity would insure a country for having a tax hole in its budget, because this would be a disaster financial instrument, I believe. So you have to try to avoid moral risk and a parametric basis, an independent, clearly defined index of parametric on scientific basis is a perfect useful. So, Robert, this is a little introduction to, I think, the basic functioning of all these concepts, whether in cat bond form, whether in swap form, whether in derivative form. And I would say, at least from our experience, you apply a catastrophe bond or disaster finance bond if you have a certain quantity. We say always $100 million or more. Of course, you can apply the same ideas, the same systematic thoughts on a smaller scale. Either you work with smaller forms of bonds or with swaps and derivatives, like the African risk capacity they do in Africa or other institutions.
Thank you very much, Henning. I think this is very helpful for the audience and giving this brief introduction in this highly complex topic. I don't know if we have
Robert, I wanted to make a point, if that's okay.
Yes, Robert, yeah.
Right, in Ludolf's point. So, of course, I work for the African risk capacity. So, I'm a proponent of this kind of insurance financing, and I think parametric insurance, as has been described, is a perfect way of knowing what is coming. However, a point that we need to make is below the threshold of attachment. Let's say if the earthquake was to strike at 7.2, that is where the payment will happen. If it is at 7, you would not get a payment. But there is still a lot of damage that has been done. So in looking at these kinds of insurance, it is important to look at contingency funding that can help countries to respond if a trigger does not occur. Because there will be, if there is an earthquake of magnitude 6 or magnitude 5, you will still have people losing wealth, losing livelihoods. So I'm just adding that contingency funding is something that needs to be added to these kind of layers because you need to layer your risk, is the point I'm making. Thank you very much.
Thank you very much, Robert. I think this is a very timely addition. I was about to ask you that I hear you have a great project in the pipeline. Maybe you can expand on this a little bit more and explain how you also cover this contingent financing that you mentioned. Robert? Seems we have problems with Robert's line, so maybe we can come back to him later. Eduardo, you have already gone through all of this structuring and working out. So what was your experience? What is your advice to fellow sovereign issues that want to come into this space, or what would you think is most important? And would you recommend this only for tail risk, like a 7.2 earthquake, or also for natural catastrophes which have a lower threshold?
Yes. Okay. Well, there's a lot to say about that point. So first, in terms of groundwork, so there's going to be a lot of groundwork to be done if any sovereign or government which wishes to access the ILS market. So number one is, of course, as already mentioned earlier, the need for data gathering. So what is your exposure? So that there needs to be some sort of inventory or database of the country's exposure of assets. That's number one. The second is you need to have some sort of a model. And there are a few firms, like let's say AAR, RMS, and I believe there are a few others who do the specialized catastrophe modeling work before that a government must engage with. So it's important that governments must engage in these with these credible firms with the track record in supporting transactions, because that's how global financial markets work, through credibility and trust. So there's a lot of groundwork to be done in terms of just the technical preparation, and then after that's done, then governments must actually sell the idea to the stakeholders, policymakers, and I am going to emphasize the point of Mr. Robert, that there is, you have to layer this thing. So it's very difficult to sell a risk transfer instrument on a standalone basis, because the first question people is going to ask you, okay, it's good and well that they are preparing for a magnitude 7.5 earthquake, but most of the earthquakes we're getting is magnitude 4, and that one way or another needs to be funded. So it's important to package this instrument and to get the stakeholder support in as a component of an overall of a broader risk financing strategy. So that's very critical. And the last point I'd like to make is that there is really no right structure, right choice of the triggers of the coverage. That would really depend on the specific sovereign needs. So, for example, the Philippines, we are most concerned about the typhoons, but I mean we are also very much exposed with the earthquakes. But the from the public point of view, it's always the typhoons that's going to grab the headlines. So that's reflected in the structure of our cat bonds. So the cat bond, our $225 million cat bond, 2/3 of that, or $150 million coverage, is dedicated to typhoons, and the remaining 1/3 is earthquakes. And so that's the that really the proper share of each of the perils, or whether or not to cover a specific peril, will really depend on the needs of the country. And related to that, so I'd like to also point out on the trigger structure. So both of our risk transfer products, the parametric insurance of 17 and 18, as well as the cat bond, we use what we call a modeled loss trigger. So we did not use what the traditional term is cat in a box structure. And the reason for that is we found that using the model, there are events where it's a relatively weak Cat 1 event, but it's generating a lot of damage simply because of its length or duration in the country. So imagine that a relatively weak Cat 1 event can be absolutely devastating if it just stays in the country for a long period of time. So that's one of the events in the risk model catalog that we had to be prepared for. So the only way to account for such eventualities was to do a modeled loss trigger. So those types of the specifics of your instrument will really depend on your specific needs. Thank you.
Thank you very much, Eduardo. This has been very enlightening and I think very helpful for anyone looking into this. Michael, coming back to you, do you think there's anything that can't be insured on the capital markets? Are we going to see an expansion from natural catastrophes like earthquakes, typhoons, or other things? I'm thinking about Eduardo just said how long a catastrophe stays in the country, and thinking about the volcano in the Canary Islands that's going on for 3 months, for example. Or I'm coming originally from Austria, from a very nice wine and apple region where we have a lot of problems with hailstorms constantly. Do you think at one point this type of insurance could be commoditized and you can buy it on a public market as needed?
That's a very broad question, I have to admit, Robert. So in fact, these types of insurance are already commoditized to some extent. If you see weather derivatives, you can just buy an insurance contract to protect you against actually too much rain, too little rain, too much sun, too little sun, actually, whatever you like to have, and it's a very widespread used instrument, in particular in the utilities, in the energy utility markets, and also Munich Re is one of the market leaders in this segment. On the other hand side, if you look into the classical actually risks that are subject actually to cat bonds, also there you could say that there's a certain level of standardization happening, in terms of the modelers that are involved, in terms of the risks that are insured, and I think way more proven kind of risks and modelers that have a good reputation seem to be the ones actually that are easier to be placed, where you get actually possibly also have to pay a lower spread. But nevertheless, as you say, we as Munich Re, we are in particular interested in looking into the complex risks, in pushing the frontiers to newer risks actually. And so this was also the reason why we had been so heavily involved into the structuring of the pandemic emergency financing facility with World Bank at times, which also reveals another problem. If you work on actually complex modeling in order to be really safe on capturing the signal in time when actually a payout is needed, this creates a lot of complexity as to the triggers, and the complexity is detrimental actually to getting a buy-in actually from political decision takers, and can also lead to reputational risk in the end. So there's also a trade-off actually of having triggers that are very, very well designed to really capture actually the signal when it is needed, as like they might get very complex actually, and many market players might not be in the position to really understand, particularly the general public. But having said this, like I think that that the cat bond space is a very good area actually to really test new risks, like, and we liked very much the initiative that was taken by the World Bank when we worked with some other participants here actually on that call, like also on the idea of making famine risk in sub-Saharan Africa insurable. And these are really like areas, I think, where all the expertise and enthusiasm, like of the ILS actually market segments come together, and where there's a huge appetite for collaboration and to really try to decalibrate these complex risks and to make them insurable. And this provides a lot of value add, not only actually in terms of providing risk transfer, but also to contribute to a better understanding of these risks, and also to inform any measures that could be taken to reduce the risk, like, and therefore I think there are not so many limits, like it's, we will also see actually other very complex risks to be subject to ILS transactions in the future, I'm convinced.
Thank you very much. That's very helpful, and we're very curious what the market provides in the future. Andy, Michael was speaking about standardization in the space. I'm running a bond issuance platform which is based on standardization, digitization, and automation. I was wondering, do you think the cat bond market, which is relatively overseeable at the moment, could grow by further standardization? I don't know, like an ISTA for cat bonds, or further digitization? And what I also would be interested, what about the investor universe? I think it's two different questions, but I think very important to touch on that as well.
Yeah, thank you. So maybe let's start with the standardization part of the question, and it's one that has come up, I think, for many years at various different panels, conferences, market gatherings. Can we make these transactions more standardized in order to decrease the costs, the effort that's required to bring them to market, and obviously to grow the market to the benefit of everybody? I would say that the answer is sort of nuanced there. It's probably yes and no. I think there is room for additional standardization, certainly. On the other hand, many clients, potential sponsors of these transactions, also want their own custom design transaction. We just heard here from, in respect of the Philippines transaction, where the specific trigger was indeed a modeled loss trigger as opposed to a parametric trigger, which was a decision by the Philippines government as to how they wanted to manage their risk with a more sophisticated trigger than, let's say, some of the cat-in-a-box triggers that Henning had described earlier. So there's an example straight away of one client who has chosen to go down a different path in terms of their transaction, and sort of defeats a little bit the object around the standardization. Now, I think that there is still room for standardization. There's been good efforts in the market to drive that. So some of the trigger structures have sort of been used a few times, particularly around earthquakes. So the cat in a box, cat in a grid type ones, we're starting to see that being reused. We're also seeing efforts by the World Bank, for example, to standardize some of the documentation using their capital at risk notes program to try to standardize some of that and make it more efficient as well. But I think there's more that can be done in that space. But as I say, sort of noting the issue will always come back to the fact that clients ultimately they want a product for themselves, for their own risk, and there's going to be some element of customization within that accordingly. So there's always going to be a bit of a balance, I think, at the end of the day. Your second question, Robert, related to the investor universe, and I think it's a really deep question. So at the moment, the market for catastrophe risk from insurance-linked securities comes from mostly specialized fund managers who are staffed by ex-reinsurance and catastrophe risk professionals who understand the risk and can sort of choose, select, buy, sell these bonds accordingly. There are some non-dedicated sort of multi-strategy asset managers who still have some of that technical expertise in-house, although there's a little bit less of that. And then occasionally you're getting the odd institution or other type of end investor sort of investing. But the vast majority comes from those dedicated managers. Now, how do we grow that? So one of the key elements will be, for me, is growing through linking these products more to their underlying nature, their more sort of sustainable, the social impact nature and of these investments. And I think a clear path to trying to grow the market, therefore, is selling them in that light. So whether it be through some kind of specialized label, where of course we've seen discussions in that direction, and of course the World Bank themselves have labeled some of these issuances as sustainable development bonds, so we're already sort of seeing that emerging, but really then trying to grow the universe of investors who could either directly or indeed indirectly support the market to help build that societal resilience. However, I think one of the issues we're always going to be facing is that this market and these products are not suitable for retail. They are complex instruments. We've talked about some of the, we've mentioned some of the scientific modeling and decision making that goes behind them. And therefore, there's always going to be a little bit an upper limit in terms of the broad marketability and support that will come from the general population, because they simply are not suitable. However, I think that there's still plenty of institutional capital out there who could make a meaningful impact with just a small allocation to these sorts of instruments. So I think there is more growth to come. And actually what we've seen in the past, though, is the limit tends to be not on the investor appetite size, which grows regardless as the market grows. So fund managers raise more money as they've got more opportunities to invest, but more it's on the other side. There's not that many products or countries managing the risk and choosing to pay the premiums to seed the risk through to the capital markets. And actually that's where we tend to see the limiting factor in terms of the overall size of the market. If we see more countries doing what we've seen the Philippines do, for example, taking the data, using a model, and this is really good sort of risk management, understanding the risk in the first instance, and then choosing whichever instrument is appropriate for them, and it could be a collection of instruments. And if we see more countries taking ownership like that, then of course this market will grow, and there will be more potential for investors to come to the market and to support.
Thank you very much, Andy. This is very encouraging view. So we need to get more issues out, I understand, and the capital will follow. We have only a few minutes left, so I would ask you for a 10-15 second summary or a wish list. What would you wish from the market, or where do you see the next insurable risk coming out? Maybe we start in reverse alphabetical order. So Michael, back to you. Famous last words.
Okay, or what I wish. Okay, I think like that. Okay, novel risk. I think like epidemics and pandemics is certainly a risk actually that is interesting, and is also a little bit actually responding actually to the situation that pandemics have been realized by reinsurers as peak risks and therefore maybe more keen actually to capital markets investors. And I really hope to see more. I think Robert can also allude a little bit on that. And as what I would like also to see is that a little bit also like from the sector of development cooperation, international cooperation, that risk transfer is really understood and fully endorsed as an instrument actually to protect countries that are highly exposed to climate risk with premium subsidies actually stemming from OECD countries. You know, like I think Jamaica is a very good example for this, and I think that is something where actually with a limited contribution, actually a huge benefit can be received in terms of supporting these countries to be more resilient against climate risk.
Thank you. Andy?
So I think echoing the same words that Michael has shared, pandemic, epidemic risk is obviously at the forefront of many governments' mind around the world. I think I would also just re-emphasize the size of this market is small today and it can be much larger. So similar comments that I recently made, it is that there's still a lot of work to do with many countries around the world to try to grow the market as a whole and to support them with the expertise that are at all of the respective firms that work in this space to develop their understanding of managing and then sort of choosing how to sort of appropriately transfer the risk or retain it or whatever that disaster risk transfer program looks like. And that comes from, you know, perils which are understood and have been done today, including, you know, typhoon type perils, hurricane, and of course the non-climate linked ones as well. So I think there's still a lot to do. But I would say in terms of directly your question, more the emerging one, then I would say obviously then pandemic is very much at the forefront of many people's mind.
Thank you very much. Eduardo, your view.
Robert, I'm sorry, can you repeat the question? I had some issues with the connection.
No worries, just you're on the other side of the globe, so totally understood. The question was, where do you see the ILS market? What would be a wish you had to the market if you could pose it, and which you see the next risks that would be insurable on the cat bond market?
Okay, I think I think it's a safe bet to see that the market will continue to grow in the foreseeable future. So there's going to be a lot of demand from sovereigns, from private institutions to properly insure their assets, you know, to have proper risk transfer instruments. And that's a result of both the increasing affluence of the, you know, as a result of overall global development. So for me, that's going to be a safe bet. Now, if I'm going to have a wish, I would like to wish that the cat bond format should be simplified, should be much simpler to execute in terms of the administrative documents. Because right now, if you want to access that market, that space without the assistance of World Bank or any other, it would be a nightmare to do so for a sovereign. So setting up an SPV somewhere in the Bermuda or Caribbean, you know, and all of those very difficult legal matters, that's going to be way beyond the capacity of middle-income sovereigns like the Philippines. So, you know, we could not have done this without the assistance of the World Bank's platform. So, you know, to make it for the market, the wish is, of course, to make them the structuring of the transactions much simpler, and of course, more engagement on the part of the players themselves, you know, to the top policymakers for more education, because the risk, you know, people are just not as aware or much that exposed towards when it comes to risk transfer. And again, in terms of assessment of risks, it's let's just say there's a lot of challenge in making people properly appreciate the magnitude or the importance of having risk transfer solutions in place. So that's from me. Thank you.
Thank you very much, Eduardo. Very wise words. Henning, a very short, because we've overdrawn a lot, summary from your side, please.
I see various ends why the capital market support for insurance solutions will grow slowly but surely. And in order of time, I pick out one. I think the sovereigns, the governments, will over time not only look at the capital markets to get disaster finance, as we discussed before, but also to try to use the backup to get more insurance for people, for low-income people, to get them a little of a safety network, because I believe this can unlock economic development in various countries. And this can be an important tool over time to help on the development of countries. So not only the huge cat bonds, but also bring more insurance to the people.
Thank you very much, Henning. I think we still have lost Robert. Robert, are you there?
I'm here. I'm here.
Okay. A 50-second opinion on you on the future of ILS.
Okay, I would say the market should look towards Africa. Even though it has a low culture of insurance, it is growing. We in ARC alone, for one peril drought of underwritten and insured about 720 million for just drought and a little bit of tropical cyclone. So multiply this to other perils, multiply it with other countries coming up. We have a 35 member states, you have 54 members on the continent. So look towards Africa. I think that there is potential here for the market to help us insure. And then
Okay, I think we've lost him again. Well, thank you all very much for your very insightful contributions. I think it's been extremely interesting. We should have had another hour for this, at least. Thank you very much. And everybody out there, I hope you enjoyed it as much as I did, and have a great day.
Solutions and Structured Finance and the Treasurer of the World Bank. I apologize I can't be with you in person, and I also apologize that I'm fighting a cold and I'm beginning to lose my voice, so I will try to speak as loudly as I can in this video. But I want to thank the organizers of the conference for asking me to make this, this brief keynote, and it really is a pleasure to be able to join you, at least in this virtual way. At the World Bank, we have a very clear mission that is articulated with what we call our twin goals: ending extreme poverty and boosting shared prosperity globally. A critical element to achieving these ambitious goals is partnering with our member countries to strengthen their financial resilience to unexpected shocks, whether those are foreign exchange rate shocks, commodity price shocks, or natural disasters such as earthquakes and hurricanes. Such shocks can roll back years and sometimes even decades of development gains. In terms of natural disasters, consider the economic conditions before disaster strikes, when conditions are normal. Citizens are earning money, governments are collecting taxes, and in many cases, governments can afford insurance premiums to protect themselves from disasters. And here are these two little girls going to school. Now, consider these conditions as they are impacted by a disaster. And don't worry, those two little girls had long left the alley before this particular earthquake struck. Economic activity grinds to a halt, tax revenues are lower, and often governments are left scrambling to come up with emergency aid. Our member governments have various options for strengthening their resilience to natural disasters, such as building seawalls, restoring mangrove forests, investing in all kinds of resilient architecture, putting aside reserves. But they also have the option to transfer a portion of their risk to the market. And one way we help them do that is with World Bank cat bonds. The basic structure of a World Bank cat bond is shown here in this slide. In summary, the World Bank enters into a risk transfer agreement with a member country under which the World Bank essentially acts as that country's insurer. The country pays us an insurance premium, and we make a payout to them if a predefined disaster strikes during the term of the agreement. Now, we are not an insurance company, so we simultaneously reinsure ourselves by issuing a catastrophe bond to the market with exactly mirroring terms, under which we pay our funding cost plus the insurance premium we receive from the country to the investors, and we have the right to reduce the principal amount for any payout we need to make to the country. So essentially, the insured position of the insurance company directly transfers from us to the capital markets investors. In total, we've issued approximately 3.5 billion of catastrophe bonds since we started this activity in 2014, covering earthquakes, tropical cyclones, and pandemics. And on this slide, you can see the individual transactions executed and for the client. In the case of the pandemic bond, the client was a trust fund which supported all of the countries in the poorest that receive aid from our poorest window, which is IDA, the International Development Association. Take as an example of a transaction we executed in partnership with the countries of the Pacific Alliance, Chile, Colombia, Mexico, and Peru in 2018. Each one of these countries has a high degree of exposure to earthquakes. And in a single transaction, which was the second largest cat bond ever issued, we transferred 1.36 billion of earthquake risk from those countries to more than 40 capital markets investors in Europe, North America, and Asia. And you can see on this slide the details of the different classes of bonds and other terms. The trigger structure for those bonds is what is referred to as a cat in a box structure. As you can see on this slide, essentially a grid pattern is laid over the country with a different earthquake magnitude assigned to each box of the grid. If an earthquake with its epicenter occurs in any box, and the magnitude of that quake meets or exceeds the threshold assigned to that box, then a predefined payout is made. This slide shows the grid for Peru. In this case, a certain magnitude threshold would trigger a 30% payout, and another higher threshold would trigger a 100% payout. And in fact, when a magnitude 8.0 earthquake struck Peru in May 2019, a 60 million payout on its tranche of the Pacific Alliance cat bond was in fact triggered, quickly providing Peru with much needed funds for its disaster recovery efforts. I hope, based on the previous slides, the benefits to our member countries of World Bank cat bonds are now clear. We are providing countries access to the insurance capacity presented by the capital markets in what we think is a very efficient manner, taking advantage of the World Bank bond program and our very well-developed investor franchise. But we also believe our work in this area is of very material value to investors themselves. For one thing, we bring diversifying risks to a market that is highly concentrated in a very few risks, such as Southeast US hurricane risk and California earthquake risk. So the sorts of risks we bring, such as Latin American earthquake risks, are completely diversifying and uncorrelated with those risks that predominate in the cat bond market. We also bring our name value and our very strong credit for the benefit of investors. Finally, we bring the value that the proceeds of World Bank cat bonds are used to support our sustainable development programs and projects around the world, making World Bank cat bonds a very unique ESG investment. And we think this is becoming an increasingly important part of the value proposition of World Bank cat bonds, as more and more cat bond investors, like investors generally, take ESG and supporting sustainable development as an important aspect of their investment decisions. With that, I need to thank you for listening, and I hope you enjoy the rest of your conference. And again, I apologize that I could not be there in person. Thank you very much.
Welcome back, everybody, after the lunch break. I'm very happy to say that the keynote speaker we just heard was Michael Bennett, Head of Market Solution and Structural Finance at the World Bank, Washington, D.C., who took us through this example of catastrophe bonds. We are now going to move to the panel 4 of today's event, and the focus of panel 4 is financing the sustainable cities through municipality financing. Unlocking sustainable finance at city level is essential to achieve Paris Agreement goals, as well as sustainable development goals, and for the European context, the Green Deal's objective. Cities can be a game changer in achieving a fair and green transition. It is estimated that around 90,000 billion of US dollars are needed to bridge the urban infrastructure investment gaps. This is huge. And local governments, public institutions cannot do it by themselves. We need to bring the private sector in. We need to unlock the private markets. So we are going to hear today in this panel how financial institutions are supporting cities in the fair and green transition, and how local governments and banks, financial institutions can work together for these mutual objectives. I would put forward the first question, which is exactly how you're fulfilling this role to provide capital markets for local governments, And I will just ask you also to provide a short introduction of yourself and your organization. So I would like now to give the floor to Antti Kontio, who's head of funding and Munifin in Helsinki. Munifin has a major role in financing municipalities in both social infrastructure and green infrastructure. And you are a standard setter in financing local government. So the floor is yours. Can you just tell us a little bit about how you are supporting cities in Finland?
Yeah, well, thank you very much, Sylvia, and good afternoon, all of you, and thank you for this kind invitation to this panel. And greetings from Helsinki. It's extremely cold here. It's been like -20 degrees for many days. So my name is Antti Kontio. I'm the head of funding and sustainability at Munifin, and I'm very happy to be here today, especially because we are talking about sustainable cities, sustainability as a whole, and the sustainable finance products. And I also need to say that the field of sustainability is growing very rapidly. Sometimes it feels like the pace is even a bit too quick. But very quickly about Munifin, as you mentioned, Municipality Finance and Munifin, we are the main credit institution providing long-term customer finance for the Finnish local governments and the government subsidized social housing in Finland, and we are 100% owned by the Finnish public sector. We do have this same ratings as the Republic of Finland at the moment, and our funding operations, they are entirely based on the international capital markets, and we issue between 9 and 11 billion euros per year. To your question, Sylvia, I think sustainability, it has always been an important part of what we do. And during the recent years, we have integrated that very strongly into our business strategy and into our values. And before I go into our sustainable products, I think it makes sense to just talk about what is basically taking place in Finland in terms of the main trends. So first of all, there will be demographic changes taking place in Finland as there are more and more elderly people in Finland, and this will increase the need for social and healthcare services as well as social housing. Also, urbanization is another topic which puts pressure to certain areas in Finland, especially from the regional vitality and competitiveness perspective. Then, of course, climate change is a big topic in Finland, and the municipalities, they have a very important role there. And finally, technological changes, they will drive these trends also in the future. So then very briefly about our kind of response to sustainability and to sustainable cities. So we have two sustainable products in place, both green and social finance. And both of them have been designed to promote the strategic themes of the Finnish government program, which is based on sustainable development. And we have been active green bond issuer since 2016. We were the first Finnish green bond issuer, and also we added social bonds to the product category last year. And currently we have more than 3 billion euros of outstanding green and social finance in place, and roughly 3 billion euros of green and social bonds. And also in terms of products, I think there are many other green issuers here as well. So we also have the same kind of approach in terms of frameworks and second opinions that we have in place. What I would like to highlight here is that we do give a margin discount for our customers whenever something is financed as green or social. So there is incentive for our clients. And also we do have external evaluation teams in place as well. So a team that finally then makes these decisions when it comes to the green or social. But I will stop here. Thank you very much.
Thank you very much, Antti. I like the way that you also included the social challenges in the sustainable transition, and you've mentioned social bonds. We might come back. We will come back later on this. I now would like to give the floor to the second speaker, Arturo Seco Presencio, who's Deputy Chief Financial Officer at the Council of Europe Development Banks. Your institution has also a very interesting role in supporting climate and social inclusion. And you have some specific funded program targeted at local level. Can you tell us a little bit about how your work has been developed recently?
Yes, sure. Thank you very much. Well, first, thank you very much for this invitation, and very nice to share this panel with my co-panelists. My name is Arturo Seco Presencio. I'm Deputy CFO at the Council of Europe Development Bank, where I'm in charge of or responsible for funding, treasury, and ALM activities. The Council of Europe Development Bank is a supranational institution with 42 country members, the oldest in Europe, in fact. And we have a unique mandate, which is to strengthen social cohesion in Europe through social inclusion, while fostering environmental sustainability across all our activities. For doing so and to participate in the sustainable development of our societies, we need to combine the social, environmental, and economic dimensions. And an important commitment for us is to align our activities with the Paris Agreement on climate change as per the Paris Alignment Framework and Roadmap, which we did announce at the time of COP26 meeting, so quite recently. At the CB, with our exclusively social mandate, we have an ESG component in all our activities, so it's applied to funding loan, but also to investment portfolios at some extent. And these allow us to have a very strong ESG rating. We finance projects through capital market issuance, with yearly issuance volume in the 5 to 6 billion euro range. And we do have a social inclusion bond framework as one of our main funding tools. When one thinks about the fact that over 2/3 of European population, some people say some statistics put it at 3/4, lives in cities, we clearly see how important municipalities are in terms of sustainability as well as growth. And these cities are essential when trying to implement sustainable economic strategies, not only in terms of carbon footprint from buildings, transport, or industries, but also in the sense of jobs preservation and jobs creation, which is something we are very attached at. Or social inclusion bond issuance, it was mentioned before, social inclusion bonds. This is a market where we've been pioneering issuers. And that activity has been very important for us. It's been increasing in 2020, since given the very exceptional circumstances, we almost tripled our social inclusion bond issuance when compared to the previous year, when the pandemic arrived. Social inclusion bond issuance is now a priority with our funding strategy, as we are creating benchmark curves for this product in both euros and dollars. In terms of the structure of the social inclusion bond framework that we issue, it includes 4 high social impact sectors for eligible projects. And those sectors, they are all directly related with the key needs for municipalities. So there's a very clear link between our social inclusion bond issuance and the needs of different municipalities in Europe, because this framework includes social housing, education, support for micro, small, and medium-sized enterprises, as well as health, 4 sectors which are beyond all municipality sustainable development. Health actually was incorporated in the framework in a record time when we decided to issue a COVID-19 response social inclusion bond when the confinement situation started in 2020. And I will just end by this question, this part of my intervention, by saying that in recent years we have increased cooperation with cities, as they are drivers of change in 3 strategic areas of operations, which are inclusive growth, climate action, and support to vulnerable groups of populations. And in fact, we find this very important because frequently cities, the city access to financing and technical expertise on these topics could prove difficult at some instances. So we have put a lot of effort on this kind of collaboration with cities and municipalities.
Thank you very much, Arturo. Thank you also for highlighting how recently cities seems to be at the center of your target for the sustainable transition. We will come back to that for sure. I would like now to give the floor to our next speaker, Frank Richard, who's head investor relations at NRW Bank based in Düsseldorf. You also have a big mission of municipality lending for climate adaptation and climate change, as well as social investments. Can you just tell us what are your main activities for municipal lending in this field?
Yeah, of course, Sylvia. Thank you for having me. I would like firstly to introduce briefly the institution NRW Bank. So NRW Bank is a regional development bank from Germany, and the region where we are in charge for is the German federal state, which is called North Rhine-Westphalia, and we are doing on behalf of the regional governments the development objectives in the region, and in this sense we are a multi-purpose development bank. So we are focused on three major business areas. So one is, of course, the municipality sector and infrastructure, where we have a huge lending business with. Second, of course, social housing, a strong, really social component is embedded in our mission. And the third important part is lending to the economy, to small and medium-sized enterprises. Finally, we have in mind to stimulate growth and to create jobs and to safeguard jobs. So that is what we have here in mind. We are owned by the regional government, that is by 100% our owner, and given the fact that we are not running a branch network, we do not have, we are not allowed to take deposits. That means we are also relying on capital market funding, and to do this smoothly, we are enjoying an explicit guarantee from our owner, which turns into the high ratings we have on the pure credit. From a pure credit perspective, it's a AA1 from Moody's, a AA from S&P, and a AAA from Fitch. But there are also strong sustainability ratings. So, for instance, a AA from MSCI or ISS ESG gives us a prime rating. From a balance sheet perspective, just to mention this, close to 160 billion euros, so that is really sizable. And the funding behind that on an annual basis in the long-term average is around plus minus 12 billion euro equivalents. And this is a multi-currency program, so we are doing a lot of currencies. It is euros, dollars, Australian dollars, sterling, and on the labeled side, on the theme bond side, we are issuing green since 2013, more or less regularly, at least once a year, and social bonds since last year as well. Topics which we allocate to social is, of course, social housing, affordable home ownership, so to offer grants and subsidized loans to low-income families, supporting education, supporting the healthcare system is key. A little bit disaster management, but also topics like wastewater treatment facilities are financed by us, and adaptation measures in the region, so river restorations, just to give you another example. Would like to stop here.
Thank you very much, Frank. Thank you for highlights the example of your German region. We are now going to move from Germany to Poland as the next speaker, Jaroslav Malinov. He's working for the Bank Gospodarstwa Krajowego, and I apologize for my Polish pronunciation, based in Warsaw in Poland. It's really interesting, the program that you have specifically for local governments. So maybe you can tell us a little bit about how do you engage with municipalities in Poland?
Welcome. Thank you, Sylvia. Welcome to everybody. Your pronunciation was great as Polish. Regards, as Sylvia said, my name is Jaroslav Malinov. I'm working for Bank Gospodarstwa Krajowego, in short BGK. BGK is, as my previous speaker set also a development bank, Polish state-owned development bank. So we are only one in Poland. Our mission or strategy from very last is based or is set in line with European Green Deal. So we are prepared to offer also green and sustainable solution for our clients. One of example from the very last time is city of Poznań, where BGK will finance purchase of very new zero emission buses. Maybe for Western Star that the value 25 million is not too big, but for the city of Poznań, I think is quite effective. What we are more doing to enable, among other, to enable municipalities to access sustainable finance. Under our strategy, there are 5 programs to support various fields like social and territorial solidarity, infrastructure, transport and logistics, or social housing. So to achieve sustainable goals, each project which comes to bank to be financed, the evaluation of each project takes into account, considers how it fits or meets the assumption of our given program. This means that thanks to our offer, we are able to influence companies and municipalities to transform or make transition into the more green or social direction. What can I more say? So I will stop now.
Okay, thank you very much, Jaroslava. I think it was an excellent introduction to the work you are doing. We are now moving from Europe to US. As the next speaker, Richard Bone. The next speaker, Ben Hunter, is the Chief Investment Officer at City Green Bank in Connecticut. What is really interesting for us as a European person is to hear about the US perspective into financing the green transition at local level. And also, US is also leading the market of municipal bonds. So maybe you can tell us a little bit how a bank like yours has also been able to influence in a more like, from bottom up the US about financing municipalities for the green transition. Thank you very much. The floor is yours.
Great. Thank you, Sylvia, and great to be here with you today and with this great panel from the United States. So first, let me just give you a little bit of background of the Connecticut Green Bank, CT being the abbreviation for the state of Connecticut. We were established 10 years ago. This summer, we celebrated our 10th anniversary. And what we do is we finance clean energy, solar, wind, small hydro, energy efficiency. We also get into alternative fuel vehicles such as EVs and infrastructure. And just this year, our remit was expanded to include environmental infrastructure, which includes things such as waste and recycling and stormwater remediation and so forth. So we operate across 3 key sectors: residential, which would be single family, and also social housing, as has been mentioned by some of the other speakers already. Many of these social housing are linked to municipalities or sponsored by municipalities. We also work with private businesses in the commercial and industrial sector and small and medium enterprises or SMEs. And we also work with our state government, the state of Connecticut, and these local municipalities. We have a big history of working with these municipalities, primarily in the area of solar. Our experience of establishing solar funds goes back to 2008, before with our predecessor organization, the Clean Energy Fund, and then our organization established 2 more solar funds. And what was interesting is back in 2015, we used the capabilities of this fund as well as some federal government qualified bonds, which involve some tax subsidy, to bring this, this low cost capital to the benefit of social housing. And we organized across these various municipalities of these housing authorities, these many towns, maybe 15 in all. We aggregated them into one series of projects, and then we had the bonds issued with a sister organization in the state. And then we were able to finance the projects quite efficiently and for a low cost, saving these municipalities more than 40% on the cost of their electricity. More recently, we have been involved with helping towns finance with the local utility programs, small business energy program that they can take advantage of. And we work with a major financial institution to buy the loans from the utility under a loan purchase facility, which is being expanded early next year to more than $100 million US. And that we will also be financing with some short-term notes that we will be issuing called Green Liberty Notes, which is an offshoot of a very successful program we had called Green Liberty Bonds, which we have issued more than $40 million worth. The other program that we have where we work with municipalities is in solar, called Solar Municipal Assistance Project, or Solar MAP. And the reason for this program is because the management of the towns, they're very preoccupied with running their towns, you know, working on things like health, safety, recreation, many property matters. And so they don't really have time to focus on sustainability matters from a technical perspective. So we bring the technical assistance and we work with them to assess their buildings and properties, particularly for solar. And then once we have one town that is ready, and we've worked with several other towns at the same time, then we aggregate these transactions and then we put them out for a collective bid in a bid process. And in this way, the competition in the market works to bring the price down. And then the Green Bank, with its knowledge of working with solar funding, we are able to then finance those projects quite efficiently. So now we have an efficient build price and we have an efficient financing process that then delivers lower cost energy for these towns. So I'll stop there, but that's just an example of how we've worked with municipalities.
Thank you very much, Bert, and thank you for introducing the focus about technical assistance for for municipalities, as well as mentioning some of the financial regulation that makes more attractive to use these type of financial instruments. And actually, I would like now to ask the speakers, how do you work with municipalities? I work for Eurocities, which is a network of big European cities. And we hear a lot from our members that it's not always easy for them to understand what is around in terms of financial products and tools. And then we also hear from financial institutions that there's money, but they have a challenge in reaching out, the potential user, which are cities. So maybe we can just start again from Antti, and if you can just tell us a little bit how do you engage the municipalities?
Yeah, well, thank you.
Do you experience any issue in take up? Do you see this knowledge gap between the work you do, your objective, and what the municipalities are actually able to do?
Yeah, I think that's an excellent question. First of all, how we work is that we provide long-term customer finance for our clients. So it's a loan or it's a leasing. And when we talk about green finance, for example, we have, I would say, quite clear criteria that we ask from our clients. Let's give an example of a new school building, for example. It needs to fulfill certain energy certificate criteria, for example. And if we see that, it's quite an easy process. It will also be quite easy for the client to provide that information. But then in some cases, it's not that straightforward when we talk about climate impact, for example. And where we see the gap at the moment, it's first of all in data. So it has been sometimes difficult to get all the data. And then, of course, another kind of challenge always is the kind of role of the bank itself and what's the kind of role of the government, for example. So how much there is actually coming pressure from the government to the local governments, for example, in terms of strategy setting for climate targets and all these kind of things. So what we can do, of course, is that we can motivate our clients to do certain things, but it's not a must. We can't force them to do that. And in some cases, there could be better ways to do it. But overall, I would say that over these years, we have provided green finance. It's more than 5 years now. Things have improved a lot. In the past, it was basically the discussion was only between the financial person in the municipality and with Munifin. But now it's more about the financial person together with the ESG person in the municipality. So it has improved quite nicely, I would say.
Yeah, thank you, Antti. I'd like now to turn to Arturo. And maybe as an additional question, I would like to ask you if the EU taxonomy has also helped us in achieving, in reaching out to local governments.
Well, on our side, when we finance some municipalities through our lending activity, and I think it would be fair to say that we expect the needs for municipality growing. So the absorption capacity is something that would represent a collective effort. Since I think the needs will be both in terms of environmental projects, but also in projects related to social inclusion, very likely related to professional education, jobs preservation, and others. And I therefore think that the lending process needs to be fast enough so the resources arrive when needed and with no delay due to an excessive reporting or administrative burden. We identified this need at the beginning of the COVID crisis in 2020, and we implemented a fast track for emergency disbursements, which was very much appreciated by the loan counterparties that accelerated the process of disbursement. And I think this kind of situation give a lesson. The lesson is that processes could be lengthy in some occasions, and an effort to optimize those processes could be a focal point of market participants, in fact. In terms of liquidity as a lender, in terms of liquidity and treasury management, I believe we need to be able to integrate the new challenges that may arrive in order to mitigate the impact of market movements and eventually monetary policy on final users of the funds we are disbursing. So in a way, we need to play the role of a buffer between capital markets and the final user in municipalities. And there's always room for improvements, again, in terms of processes. There are serious challenges coming from both inflationary pressure and the link between salaries and purchase power, which will need to be confronted with eventually projects related, as I mentioned before, with jobs creation and preservation, and that's going to be very seen in cities and municipalities if the income gap is to be contained, because cities is one of the city population is one of the main sufferers, I would say, of the income gap. Economic transformation will go hand in hand with challenges in professional skills, and professional education programs will need to be financed. And maybe just to finalize with your question on the European taxonomy, well, European taxonomy on the green bonds and green market is going at a faster speed, I would say, than the social taxonomy, but social taxonomy is on its way as well, and different market participants are participating in both. I think that everything which clarifies the way forward for market participants could be interesting and of added value.
Thank you very much, Arturo. I'm now going to turn to Frank. How do you engage the local governments? Do you experience any issue with low take-up from cities, for example? How do you encourage city to come to you?
Yeah, first, how we collaborate with municipalities. Of course, we are the bank. They have a financing needs. That means we have a bilateral loan business with them. On top of this bilateral loan of business, of course, we have an advisory service. So we are looking into the debt structure, how to optimize it, cash flows, and so on. But coming back to the bilateral loan business, we are working very closely with the EU taxonomy if it comes to the green topic. So, and I'm very close with Antti that if there is a project which fulfills the technical screening criteria, the do no significant harm criteria of the EU taxonomy, then we are sure that we could use this project for being refinanced with a green bond capital market transaction. Then we all know that there is a greenium in the capital market, where is an interest rate advantage for issuers if they issue in green. And what we are doing, we are passing this advantage through to the lending side. So that means we are offering to municipalities two lending curves. That is a conventional lending curve for conventional business, and if it is a green topic, we could refinance this with an additional interest rate subsidized loan. Let's say currently it's around 5 basis points. What is easy if we have business with single purpose companies? So, for instance, a public sector company running public sector in a city would like to change from old diesel-driven buses into hydrogen or electricity drives. So that is easy for us to understand. It's getting a little bit more complex if we are talking to the core municipality. And often the finance department does not really have a clue about what the final use of the funds are. And we encourage them to have a communication with the technical department to get more information. And that is, of course, the data. So we have a gap in data. And again, close to Antti, we need more information. We are willing to pay for this information with an additional interest subsidies, and finance departments understand this. We are make them confident and comfortable with that. We're organizing conferences in the region to connect the people. And then, of course, they pick up the phone and call the technical department and ask for the EPC level of a new construction, for instance, and so on. So that is how we motivate them.
Thank you, Frank. You also mentioned some very crucial issues of how you provide information on what is available for cities. And I think that the issue, you also think that there's a lack of data and information. I mean, both you and Antti mentioned this. I'm really interested because, as I said, I work for this Association of European Cities, and we're also looking into the issue. And there seems, I totally agree, there's a lack of information on what is really needed at local level, but also, because I'm speaking from the side of cities, what is available on the financial side and how practically this is going to work. So this idea of having regional events and conferences seems to be going to the direction of closing the information gap. I'd like now to move to Jaroslav and same question. How do you work with the Polish municipalities? Jaroslav, I think you are unmuted. We cannot hear you. Okay, I see you have an issue with the microphone. Okay, let's see if you can solve the issue with the microphone. Just let us know. I will give you the floor again. But we can now go to Bert. And maybe you can tell us if the situation in US is any different. Are municipality more eager to come to you to explain what are their financial needs? Do you find it quite easy to work with municipalities, or do you also, as the previous speaker mentioned, do you feel there's a lack of data information and there's an untapped potential actually?
Well, thank you, Sylvia. Actually, I would say that when we started out back in 2011, 2012, 2013, there was a lack of information. The websites were terribly confusing for all the users, including the municipalities. We joined in an effort with our state authority and with our utilities to combine all of the information into a unified website of information under one brand. It's called Energize CT. So everybody now knows if they need to find out some information about energy efficiency or renewable energy or sustainability, they can go to Energize CT and find the information for their particular sector. And all of the resources are there in one location, so that that eliminated a lot of the confusion. And then as we made progress in working with the municipalities, I think we benefit from two things. One is at the citizen level, there are these environmental task forces. And we're in New England, which is the region of the United States where we are. There's very much a desire to pitch in and be involved in these types of activities. So these environmental task force by the citizens really rally the towns to do the right thing with energy efficiency and renewable energy, in particular solar. And so that has helped the towns also, who come together regularly, as was mentioned, in meeting each year or sometimes twice a year to talk about various issues. Many of these will be around public safety or recreation, and things of that sort, but they are also increasingly now talking about energy efficiency and renewable energy and sustainability with the coastal impacts of storms that we have been experiencing more recently. So through these meetings and regular occurrences, we then with state authorities can join in the conversation. And so now the towns and municipalities recognize us as a resource to help them with technical assistance and also with financing. Because in the United States, and quite often, I know from our experience, but it is similar, I think, throughout the country, raising funds can be very complicated. It quite often can require that the entire town come to vote to approve of the raising of capital. And so the towns are quite reluctant very often to do these things unless it is for the usual things like building a school or some other town facility. But to use the capital for efficiency or for renewable energy is not really, it's discouraged because it can be quite an activity for the town to organize all of these things to raise the capital. So what we do is we work on ways that we can get the capital for the projects that do not require such a vote. And one mechanism I mentioned was the small business program, where the financing comes from the utility. We provide the capital, but they originate the loan. So it's a good relationship there. And then the loan is paid back by the municipality on the electric bill. So this process, since it is viewed by the town as being a utility program, an electric utility program or a gas utility program, it does not have to go through the usual approval process. So it bypasses that need. It is seen as a special program. So that's good. And then on the solar side, because we present the opportunity via a power purchase agreement, the town is entering not into a capital arrangement, but a service agreement. So they are buying the electrons instead of raising capital to build, say, solar on top of a building or ground mounted solar. So they do not expend any capital at all. They merely enter into a service agreement for the electricity. So that is another way that they avoid having to go to the town to get a vote. It's just they sign a contract and then they can have clean energy and lower their cost of energy.
Thank you very much, Bert. Very, excellent example of, you mentioned the role of the local population and citizens in this financing, having access to finance, which is also very interesting to take into consideration, both in asking municipality to provide for infrastructure, but also in making things a bit more complicated. And they also mention how complex the financial portfolio tools available can be, which is not always easy for a municipality to really navigate this, and the importance of advisory services, capacity building programs. I would like to see if Yaroslav, is your microphone now working? Oh, great. So now the floor is yours, and you can just tell us how you make sure that the Polish municipalities can make the best of what you provide.
Since our internet is not so winter resilient like in Helsinki, almost we have only -3 degrees. Coming back to your question, Sylvia, let's have a bit of background of specific of Polish debt market. From all most of all the municipalities are looking for cheap money. Every additional cost, for example, to build a green bond framework or to allow or let the second party to check the documents for green are seen by most of the issuer unnecessary burden. So in fact, we have on the one hand only 2 or 3 really green issuances, municipal issuances, with proper green bond framework, with proper second party opinion. But when we look more closely, on the other hand, most or almost most of today's investments of communes and small and bigger municipalities are somehow green or somehow social. Most of them are what we invest, maybe not what we finance through origination of bond, is the renovation of water supply systems, better clean water recovery, thermal modernization of housings. That's all somehow influences better life circumstances for the local citizens. And let's say it fits actively in the European Green Deal. Role of the BGK is not to compete with private investors, only to fulfill gaps when sometimes happen that not all needs of the local municipalities will be covered by private money. The good thing we see that banks and private investors more and more are looking for green investments. So they somehow try to convince issuers to have more and more green or socially developed projects. Yeah.
Yeah, thank you very much, Jaroslava, also for picking up on some very crucial issue. Unfortunately, we are approaching the end of this session, and I think we've picked up on several issues about what the financial institutions can provide, some of barriers for local government to have access to finance. But now we have 3-4 minutes left, so I would like, as a way to wrap up this panel, to give you the floor, and you will have less than a minute to make your final statement, and you can maybe focus on one recommendation for policymakers to improve the uptake of local governments into sustainable finance. I will start with Antti.
Well, yeah, thanks a lot. And I think the most important point here is that a lot is happening around this topic all the time. The pace is very quick. So it would be very nice if all participants could be as open as possible, not against things, but open. And I'm not talking about only the financial companies, but also regulators and clients and all that. But in terms of the clients, I think the most important thing when it comes to sustainability would be that the clients, they would have a clear sustainability strategy in place, and they would also have clear KPIs in place. So they would actually very clearly say that, okay, this is what we want to achieve by this year, and this is the way how we're going to do it. So that would be very nice to see in the future. Thank you.
Thank you, Antti. Arturo.
Yes, well, I would like to make a point on the fact that I think that needs for municipalities and for many other actors in the economy, but for municipalities, they would be more and more holistic in terms of the interlink of environmental projects and social inclusion projects. And somehow regulators and policymakers, they should take that into account in order to make those processes that I was mentioning before as efficient as possible, and being able to disburse necessary funds in projects which will, of course, in municipalities take into account both aspects.
Thank you. Frank.
Yes, what I would love to see is that we were able to close the gap in communication in the core municipality here in my region. So we need more exchange of information between the several departments. They must communicate more intense with the finance department, which is a gateway to the capital markets and the funding of the municipality. So what we need is more information about the projects behind that. And of course, this project should fit into the Green Deal and fit into the EU taxonomy. We need to meet these criteria, and we are on the way to be CO2 neutral in 2050 or 2045. So we have to achieve this, and I guess municipalities have to contribute and they have to move. We try to keep them motivated. But of course, it's coming closer to the year end, and Christmas is coming. And my wish for Christmas and for the next year is, of course, that we get rid of this COVID-19 pandemic and that we have the possibility to travel a little bit more, to meet people, and to stay in touch.
Yeah, thank you, Frank. And we didn't really went into the issue of COVID and the need of investing in social infrastructure. That will be another panel. Bert.
No, I would just say that progress along these areas for municipalities requires not only engagement of the leadership, but it also requires the engagement of the citizens of the town. And so another pathway that we have opened up with our Green Liberty bonds and now with our Green Liberty notes, which we make available at 900 euros for the bonds and 90 euros for the notes. It's very easy for citizen investors to get engaged in this process. And we think that by making them aware of their ability to participate, then they will encourage the politicians to move on this activity, which is very important.
Thanks. Yaroslav.
If I should have one word, I would say education. I think it's in line with my previous speakers. But what we need is education, not only on the policymaker side, but also on the citizen side. They all have to influence our investments and building up the health projects.
Thank you very much. So I've picked up a clear targets on sustainability at local level, better integration between green and social infrastructure, better communication and collection of data, engaging citizens, politicians, and providing a proper education program. I think that I will really, these are like the summary of what we need to do to make sure that the financial world and municipalities are coming together to achieve the objective of a Paris Agreement, Sustainable Development Goals, and the Green Deals. And there's a lot of commitment from cities to move towards sustainability. So I think this is just the beginning of a partnership that is just starting. So I would like to thank you very much. Thanks the speaker, Arturo, Antti, Frank, Bert, Yaroslav. You've been really excellent in making a summary of what you are doing and what are the challenges that we need to face very soon, because we don't have so much time to deal with climate change and climate adaptation. So thank you very much, and let's keep this dialogue between cities and financial institutions ongoing. Have a good rest of it.
Welcome, good morning, good afternoon, good evening to everyone joining us. My name is Glenn Pierce-Oroz. I'm Senior Director for International Relations and Special Projects with Sustainable Energy for All. And I'd like to share with you a warm welcome from very snowy Vienna this afternoon. It's my pleasure to be moderating this hour of Future Europe, Sustainable Europe. And we'd like to start at the top of the hour with a very important message and keynote address by a colleague and a friend of SE for All's, Mr. Andrew Herskowitz, who's the Chief Development Officer for the US International Development Finance Corporation. And Andrew, if you could begin with your keynote, but also I wanted to share that closing the energy access gap is something that is very, very close to SE for All's heart, certainly. And part of the challenge in closing the energy access gap is that there are so many moving pieces. Andrew has vast experience in thinking through these challenges, and we look forward to his remarks right now. Thank you, Andrew.
Great, thank you so much. It's obviously something that's near and dear to my heart. First, I want to thank DZ Bank for hosting this conference and for giving me the opportunity to speak to all of you. My name is Andrew Herskowitz. I'm the Chief Development Officer at the U.S. International Development Finance Corporation, which is the U.S.'s relatively new development bank. We replaced the Overseas Private Investment Corporation and USAID's Development Credit Authority, which was its loan guarantee office, and merged and have been given new authorities, and we're just going gangbusters right now. We just announced, for example, yesterday, $1.1 billion in new projects, including a $500 million investment in solar panel manufacturing in India with First Solar. So think of us as the US government's version of IFC with a $60 billion ceiling, and we're only using up 31 billion right now. So we are wide open for business globally, with a particular focus on making sure that we're having development impact. My personal background prior to being in this position, I joined DFC 2 years ago, right when it was created, was I was the coordinator for the US government's Power Africa initiative, which is the largest public-private partnership for development in the world in history. We have over 200 partners, including SE for All and others, I'm sure, who are on this call as well. And we helped over 120 power projects reach financial close while bringing first-time electricity access to over 100 million people. And Power Africa continues, and I remain passionate about this. So it's a little bit more background on DFC quickly, just before we get into the discussion on energy access. DFC has many tools. We provide debt financing. We have political risk insurance. We've got loan guarantees as well. We have a new equity tool as well, so we can make equity investments on a project basis and in funds. And we also have a technical assistance tool. So we have a broad array of tools that we can deploy to try to address this issue. DFC also announced some very ambitious climate goals. We announced our intent to try to achieve net zero by 2040. That we're by starting in 2023, we're aiming for 33% of all of our investments to be climate related in some way. We did a really bold call for applications for distributed renewable energy, and we'll talk a little bit about that because distributed renewable energy and microgrids continue to be challenging from a commercial standpoint, and we wanted to see what sort of response we would get, and we're really pleased with that response. We also announced a $50 million technical assistance facility to help drive the climate agenda. And we also announced a call for proposals for investments in climate funds. So we're all in on the climate agenda, but we're also all in on making sure that the climate agenda doesn't push, as what Jim Kim once described was as energy apartheid. And we recognize that as you look globally, you have 1 billion people who don't have access to electricity. You've got 3 billion people who don't have access to clean cooking. We need to make sure that as the African continent continues to grow, to have a population of 2 billion by 2050. And by 2100, I think something like 13 or 16 of the largest cities of the world will be in Africa, including Lagos is projected to have a population of 100 million people. We need to make sure that the policies that we're implementing today aren't going to leave people behind. We need to make sure that our climate agenda isn't driven to benefit the youth who are living in Europe and the United States and Asia and wealthier countries in Asia, but it's geared toward making sure that the youth and children in Africa are going to benefit from the climate agenda. And that really requires an all of the above approach to trying to achieve energy access. Now, what is energy access? It means different things to different people. With Power Africa, I said that we helped 100 million people get electricity access. But that's not a number that I really celebrate, because a significant portion of those people who got electricity access are getting their access from standing around a solar lantern. We count it, but we decided to cap the number of people who we count from getting electricity access from just a solar lantern. We like having solar home systems as well, so that a solar home system gives a person, gives a family a greater level of electricity access, whether it's mobile phone charging, watching television. And there has been an attempt to develop highly efficient appliances that can operate from those solar home systems. But at the end of the day, you can't boil a pot of water from a solar home system. It just doesn't provide enough power. And as long as 3 billion people globally are continuing to use charcoal, firewood, biomass, clearing out forests essentially for cooking, we can't say that we solved the energy access problem, even if we get everybody in the world a solar home system, because we're going to continue to have major climate impacts. So we have to be bolder. We have to come up with solutions that people can actually afford. The World Bank and others have made some really aggressive attempts to get people connected to the grid, particularly in Kenya. And we've learned a lot from that. You can connect people to the grid, but if they can't pay for the power, or if they're not using the power, then it doesn't do the utility any good. So you have to come up with solutions that aren't going to hobble the utilities as well, which are already constrained financially all throughout the African continent. I believe there are only about 2, maybe 3 utilities that are even financially solvent on the African continent. So when you ask a utility to start connecting people who you know very well won't be able to pay for the power and won't use very much power, then you're setting up that utility and the entire system for additional failure. So when we look at energy access, we really have to look at not just the solar lanterns, not just the solar home systems. We have to look at how are you going to get people modern energy access. It may be well and good that people are getting their basic electricity from a solar home system, but they're going to need access to cooking gas as well, and coming up with integrated systems as well. One of the things that DFC I mentioned that we did was we issued a call for applications for distributed renewable energy. That includes everything from commercial and industrial. It includes microgrids at the community level. And we want to see if we can get this sector, which has really struggled to demonstrate commercial viability, to the point of commercial viability. We want to see if there can be a few quick wins. Our hope is that costs will continue to come down. We've seen solar panel prices obviously come down significantly. We expect battery prices to come down significantly as well. And we've entered into partnerships with the Rockefeller Foundation, which committed $50 million to help DFC de-risk investments in the distributed renewable energy sector. We entered into another partnership with the Shell Foundation, which committed approximately another $45 million to help DFC de-risk investments in e-mobility and energy access as well. And we have to figure out how to smartly use those commitments from those foundations so that we can invest in what we think will be commercially viable projects. Now, what is the best use of that funding? You know, perhaps it's used to help buy a currency hedging tool so that we're not causing greater stress to our clients who may be taking out loans in hard currency from DFC, but they're already struggling to demonstrate financial viability. And those costs ultimately, when they pay back in dollars 5, 10, 15 years from now, are going to get passed on to the consumer, the very consumers who are already struggling to make payments in the first place. You know, that financing, that grant capital from Rockefeller, from Shell, it also might be used simply for technical assistance. What we see in a lot of countries is that there's not the enabling environment to ensure that microgrids and other off-grid solutions can operate in the country and either compete with the grid or complement the grid in some way. So we're looking at a whole array of solutions right now about what we can do working together, whether it's local currency, lending, looking also at trying to improve the enabling environment. But what we do know is it's not a solution that we can provide by ourselves. This was the idea behind Power Africa, recognizing that no single agency with any one government or no one government, even when you wrap up all the agencies, can do this by itself. The power sector is so incredibly complicated because initially everyone thought that if you just produced a lot more power, people were gonna get access, but we continue to struggle to see sufficient transmission and distribution systems. So it really requires an all hands on deck approach, which is what was the idea behind Power Africa. It's still that we still have a very, very long way to go, but we've learned a tremendous amount over the last few years. And we're gonna continue to work together. So I really wanna thank DZ Bank. I wanna thank the folks who you're about to listen to on this panel, who all know this sector quite well as well, and make it clear that DFC and the US government is strongly committed to making sure that we don't, in fact, have energy apartheid moving forward, and that we're committed to making sure that the billion people who don't have electricity access and the 3 billion people who don't have access to clean cooking will get access to both of those things in the coming years. Thank you very much.
Thank you very much, Andrew Herskowitz, for framing some of those challenges so very well. I'd like to now move us into our panel discussion, which will be focusing on adapting to the structural shifts and new financial realities of sustainable finance in the Americas. And I appreciate very much reflecting on energy access challenges, but then shifting into the Americas. Because when I think of everything that's happening in Latin America, I think of innovation. I think of the inequality, certainly that's undeniable, that exists. But there's also an embarrassment of riches in terms of biodiversity in Latin America, which I hope will come out in this discussion with our esteemed panelists. We have with us Carolina Cortés, Principal Executive of the Directorate of Sustainability, Inclusion, and Climate Change at CAF, the Development Bank of Latin America. We have Slav Gachev, Deputy Managing Director of Sustainable Debt at Nature Harvest, the in-house impact investing team at the Nature Conservancy, TNC. Eusebio Gar, Head of Funding, Treasury Division at IDB Invest, the private sector arm of the Inter-American Development Bank Group. Patricio Sepúlveda, Head of Public Debt Office, Ministry of Finance, Gobierno de Chile, and Jesus Guzman, Head of Debt Capital Markets at BECIE, also known as the Central American Bank for Economic Integration. So welcome to our esteemed panelists. And I would like to move a bit quickly, but start with a few questions to each of you. And if I can start with a question to Carolina, who joins us from CAF, which has stated an ambition of becoming the green bank for Latin America. In Glasgow at COP26, CAF announced $25 billion of its operations would be targeted over the next 5 years for greener activities, greener operations in your different client countries. What opportunities, Carolina, do you see for CAF in terms of financing nature-based solutions that can help make Latin America's biodiversity even more sustainable? Over to you, Carolina.
Thank you very much. Good afternoon, Glenn. Before I start, I would like to thank DZ Bank for inviting me to be part of this event. And also, I'm honored to be part of this extraordinary panel with Jesus, Patricio, Eusebio, and Slav. Greetings to you all. Also, finally, Andrew, thank you very much for your keynotes regarding energy access. As you can imagine, Latin America and the Caribbean region is only responsible for the 12.5% of greenhouse emissions, but is one of the regions that it will be most affected by climate change. I can give you some examples. Extreme temperature will cause extreme variability in rainfall in the Patagonia, Central Brazil, the Caribbean, and Central America. An increase in tropical hurricanes will be affecting more and more insular territories. A rise in the ocean level already is affecting millions of people from Uruguay and Mexico. These effects will have direct consequences in the regional economy that even before the pandemic were already showing a slowdown. Faced with this reality, the commitment to green growth appears as the safest for the well-being of our region. We need to anticipate the inevitable transition to greener, resilient, and more inclusive economies in the coming decades. This implies succeeding to raise the vast financial resources to foster green growth. According to the United Nations Environment Programme, until 2050, we need to invest $8.1 trillion to protect natural ecosystems and biodiversity. The financial needs are overwhelming, but some mechanisms can bring us closer to them. In this sense, multilateral banks as CAF will play an important role to catalyzing additional investments and offering investors the security they often need to make large disbursements. The Green Growth Path also involves connecting with local actors such as national development banks and the commercial banks, ensuring that we are all coordinating our action. We need to show that business opportunities are appealing and that both investments under institutional frameworks will be guaranteed. Despite the magnitude of the challenges, Latin America and the Caribbean have the potential to redirect this course. From CAF, Latin American Development Bank, we put forward a green banking agenda from now on, which should be leading from becoming us the Green Bank of Latin America and the Caribbean, as you already mentioned, and is our lead executive president, Sergio Diaz-Granados, which has stated it. This has several connotations, but fundamentally, it will lead the bank and as an ally of its shareholders' countries in fulfilling their national and international environmental and climate commitments. CAF has more than 50 years of work in the region, knowing our economy and social realities from our own countries. To this end, CAF will employ concerted strategies with environmental sustainability, social inclusion, and climate resilience in all sectors of the region economy, in line with the postulates with the 2030 Agenda that establishes Sustainable Development Goals, the Paris Agreement, and the Global Biodiversity Framework. To this end, CAF will be developing its Green Strategy 2026, which seeks to support Latin American and the Caribbean countries in meeting their national determined commitments through the financing of public and private projects that facilitate the transition to a low carbon and climate change resilient economy. This strategy to strengthen strategic alliances with international and local investors and financial partners such as pension funds, environmental and climate funds, as the Global Environmental Facility, the Adaptation Fund, the Green Climate Fund, other regional and national development banks, private banks, among others, whose practices are within those with CAF. In the last 4 years, within the environmental and climate funds, CAF has approved specific climate action projects for programs for 11 of our 17 CAF members countries in Latin America and the Caribbean. CAF's Green Strategy will seek to highlight financing for operations that include interventions to enhance the value of natural capital, climate change mitigation and adaptation measures, and nature-based solutions. With this, CAF aims by 2026 to reach 40% of our approvals in green projects and 50% by 2030. Under this strategy, CAF will prioritize the following action areas: capacity building, through the new different types of allies, such as universities, foundations, NGOs, subnational governments, through which to exchange knowledge and best practices and enhance CAF's capillarity. Consolidation of a territorial window, cities, rural development, and marine coastal zones, seeking to establish synergies between territories their population, and the development sectors such as water, mobility, connectivity, agriculture with food security, and industry, promoting of financial low carbon mobility and infrastructure projects, prioritization of the integrated and diverse regional energy matrix. Strictly with your question, what opportunities is CAF starting to see in terms of financing nature-based solutions? All of the previous mentioned will be developed in the implementation of an environment and climate facility to finance pre-investment studies for initiatives with environmental and climate co-benefits with non-reversible financing resources. Increase the green financing in the capital markets under our CAF's Green Bond program. Creation of a regional knowledge exchange platform to address the climate crisis and biodiversity loss. Construction of a platform for mobilizing climate and environmental funds during the period 2022-2026 that will make it possible to lead us to mobilize at least $1.5 billion in concessional financing for the region.
So Carolina, we have several of your fellow development banks on the panel, and so we're looking forward to having a discussion around the different approaches. CAF certainly is going to be one of those leaders. And you mentioned something regarding strengthening alliances across different public and private investors, which leads me to perhaps ask Slav to join the conversation, because NatureVest, which again is the impact investing team of Nature Conservancy, has launched a Blue Bonds for Conservation initiative. And I know that there was recently a deal that was closed in Belize for $553 million debt conversion that NatureVest was in the middle of. And this is precisely that alliance that you were talking about, Carolina. Slav, if you can share with us what you see as some emerging lessons from this operation, as well as what are some preconditions for success when you think about doing this in other countries.
Yeah, thanks so much for that, Glenn, and very happy to be on this panel. Thank you, Carolina. I was pleased to hear that CAF intends to cooperate with NGOs such as ours, and so I look forward to discussing opportunities for cooperation with you bilaterally, as I am with the other panelists, and indeed many in the audience. Yeah, and I I would be remiss if I didn't thank in particular DFC and Andy Hertzkowitz for their support in this transaction, as DFC provided a very innovative instrument, or shall we say, allowed the innovative use of a traditional instrument, which is political risk insurance, in the context of a capital markets issuance. And so through DFC's credit support, we managed to raise 364 million of new money to retire the existing Belize super bond of 553 million, like you said, Glenn, which represented 30% of its GDP. That was the country's sole commercial borrowing. And through this operation, we reduced the indebtedness of the country by 12%, and immediately the rating agencies upgraded Belize from selected default to B-. Our transaction itself was rated AA- on the back of the DFC guarantee or political risk insurance. And not only did it have a powerful effect on the debt sustainability of Belize, but from TNC's perspective, it accomplished very important climate and biodiversity goals. The country committed to protecting 30% of its territorial waters in the form of marine protected areas to undertake a marine spatial planning exercise through our help, which will, set the boundaries of these new marine protected areas in a very stakeholder-driven consultative process. In addition to the policy commitments, our operation unlocked $180 million over 20 years in conservation at no net effect, no net borrowing to the government. So when I was talking about the 12% reduction in the country's indebtedness, that actually takes into account the commitments towards conservation funding. So this transaction basically allowed the twin objectives of biodiversity protection and funding at no net borrowing from the perspective of Belize, quite the opposite at net debt reduction. So this tool can be an extremely powerful tool towards nature-based solutions to climate mitigation and adaptation. We absolutely would love to replicate it elsewhere and to work with willing sovereigns and DFI partners to do these structures elsewhere in the Americas. We have several discussions now in the Caribbean and in South America, and we would love to continue those, to deepen those, to expand those. I also am noting that IDB is represented on this panel, and we're having a very productive discussion with the sovereign colleagues of Eusebius around what we could do together in IDB's footprint. So let me pause here and would be happy to answer questions later on.
I think the experience is so rich, Slav. I'm sure there are many questions to understand it much better. But you did mention IDB. We do have the benefit of having our colleague Eusebio with us from IDB Invest. And alongside this innovation in Latin America on how to adjust financing opportunities, private sector certainly has to play a role. I know IDB Invest is very much focused on transitioning the private sector to a greener economy. Eusebio, if you can share with us, how does IDB Invest use green and social bonds to promote this transition among your clients?
Thank you, Glenn. First of all, thank you for the invitation to this panel. It's a pleasure meeting all of you and to represent IDB Invest, which is the private sector institution of the IDB Group. We are a multilateral development bank with a mission to promote the economic, social, and environmental progress of Latin America and the Caribbean through private sector companies. So our clients are financial institutions, corporates, and infrastructure projects. Climate change is a key strategic priority for IDB Invest, and we are committed to channel at least 30% of our new origination every year to projects addressing climate action. Additionally, to our overall green standards for every project we undertake. We have also declared a commitment to align to the Paris Agreement at the recent COP26 conference in Glasgow. We at IDB Invest see green bonds as a key tool to get the private sector in the financial markets to contribute to the climate change goals. And we engage actively with our clients, both as advisors and investors in their bonds. We also have set up our own sustainable debt framework, which allows us to issue green bonds, social bonds, and sustainability bonds, a range of different thematic bonds, which we made aligned with the green bond principles and the social bond principles. We underwent an external review by VGO Iris, an external second opinion provider, kind of aligning to the standards, to the global standards, and also providing a template to our private sector clients of how to approach green bonds, making sure, and this is a very important part of our advisory work, that they understand that green bonds are not a fad. It's not the flavor of the month. It's not something which is cool to issue. It's something that if you want as a company to do green bonds, you want them to be part of your overall strategy. You need to have a commitment as an institution to approach the climate change issues relevant for your industry, to embed that into your strategy. And as part of an overall effort to address climate change, you can use green bonds to highlight to the market and to your stakeholders your commitment, and also to provide transparency about your efforts. Because the beauty of green bonds, in my view, it's an accountability device. The very moment you issue X million dollars of debt in a public market, committing to channel them to address climate change, you commit yourself to report on the use of proceeds. I think the strength of use of proceeds frameworks is exactly that they provide a commitment to transparency, and that investors, outside investors, can hold companies accountable for their declared efforts. It's easy to to kind of put commitments out there in the public and hope they are forgotten over time. But when you have investors buying a 5, 7, 10-year bond and asking every year, well, what is the report? What are you doing? What are the projects? What are the indicators? That's something we spend a lot of time explaining to our clients. This is not a project we do in the next couple of weeks and then we have the green bond out there. This stays with you and can only make sense to undertake if you are, as an institution, committed to the cause, committed to addressing climate change. It ends up in very rich conversations with top management of our clients about whether or not they should undertake this. And of course, our role is, given the commitment I've expressed, to really compel them to undertake this effort. But we do want to make sure that they understand the importance of being very serious and very committed, because that only then we achieve two things. First, we achieve our climate change goals, but also they achieve what they want, which is the recognition for that commitment, the external recognition for committing within their overall strategy to address climate change.
Eusebio, thank you very much, because I think we're rounding out. Carolina certainly talking about what CAF is doing with many of its member states, with many of its country clients. Slav on debt conversion, on innovation, in terms of bringing these different alliances together. IDB Invest with what the private sector needs to do. And so I think it will be really interesting, Patricio, to turn our attention to the case of Chile, because in Chile, there's clearly a lot of innovation in terms of financial markets. The sustainable bond framework that was launched, I believe, a couple of years ago, was an effort to, as Eusebio said, make sure that green and social sustainable investments were not a fad, but were long-term. And so you do have some experience now in setting this up as government of Chile, the sustainable bond framework. What advice would you have for other countries who want to develop a sustainable bond framework as a way of diversifying your financing for green projects, for social projects, for sustainable projects? Patricio, over to you.
One second. Yes, thank you again. And first, thank you for the invitation. So you're right. So I will start to give you the situation now of Chile, but I will also explain the evolution from the last 2-3 years. Currently, we have issued about 26 billion of thematic bonds. So this is a very important share of the debt. For example, it represents about 25% of the Chilean central government debt. We issued a mix of green bonds for about 7.7 billion US dollar equivalent. Social bond for about 16 billion US dollar equivalent. And also we issue sustainable bonds in this year. So I think that it's a very important signal to the market that for the government, but also for the country, the thematic of the environment and also the sustainable growth is very important. This is for us a tools to share with the investor, also the analyst, the commitment of the government. So this is very important to have a very credible story in the country. So when we visit the investor, and we have right now since the last 1 year only by telematic, sorry, we explain that the story of Chile is not only this issuance of thematic bond, because it's part of a country strategy. For example, the NDC commitment and the Paris Agreement that we have last year, update in 2020. We also have a very important initiative, for example, the plan for the closure and replacement of thermoelectric power plants. We have also an important development of a national electromobility strategy. We have also a plan to search alternative energy like the green hydrogen that we have in Chile. We have also established the carbon neutrality goal by 2050 in the climate change bill. In the social dimension, we also in Chile experience a very important story to explain the reduction of, for example, a very simple dimension is the poverty from the 68 that we had in 1990 from the current level of 8.6%. So in terms of the lessons of this, I think that we obtain a very impressive new additional investor interest in these thematic bonds. As I mentioned, we began first with the green bonds, but then we expand and we issue social and sustainable bonds. But the participation, for example, in the transaction 2019 in the Europe was about 80% of the demand come from ESG investors. In the US market, it was a little bit lower, about 40%. But it was impressive. So we obtained also very important greenium, so about 5 to 10 basis points. So we obtained two things important. For, of course, the DMO in Chile is the cost of the debt. We increase the investor. We also reduce the cost of the debt. But also for the DMO, it's important to tell the story of Chile. For me, I have had to learn more about all the thematic, the green thematic, the social thematic, because we have to explain to explain all the topics new for us. It was more easy to explain this than, for example, to explain the macroeconomic development, the fiscal situation, macro situation, monetary policy situation. So I think for us, it's one of the best or the first lesson. The second lesson is the selection of the projects, because we have internally in the government a committee that select the project in two main topics or two main characteristics. Is first the capacity to report the allocation over time. So not all the project is easy to have this monitoring of the allocation of the resource. And second is to calculate the impact. Also, we have also to select the project that will have the capacity monitorize and to calculate the impact. Because the report in this area is key element because is related to the credibility of the issuer, and I understand it's very important also for the investor to know that when they invest in one instrument and one issuer, they will receive a strong report of allocation and impact report. So I think that is the second lesson, that we have to be careful, to be very careful regarding the project that we incorporate in the bonds.
I think that's an excellent point, Patricio, and I know there are many other lessons that you would be able to share with us. I'd like to, however, go from Chile to Central America, because the realities are quite different between what we have in Chile and what we have in many Central American countries. And Jesus, the vital work that CABE does with Central American countries, I think puts you in a very privileged position on this panel in terms of what type of opportunities do you see in Central American countries, which vary in terms of their development, which vary in terms of their levels of inequality. But CABE has put together a social bond framework to precisely try to help many of these countries attract more financing. What does CABE need to take this to the next level to increase in scale the use of its social bond framework in Central America?
Thank you, Glenn. Thank you for this question, and thank you for all the panel, and hello to my colleagues now in the panel. Yes, I will give some background on this, Glenn, so that maybe we can concretize more this opinion, or it will be sounder on how we can increase our reach of our social bonds. So first of all, CABE, the social and economic impact in the Central American region, it's a mission. It's on the ADN of CABE since long, since it was created is more than 60 years ago. So that's part of our mission. So working on the eligibility criteria, impact reports, selection of process, use of proceeds, transparency, reporting. It seems important part of the work of CABE. And we have decided recently to put all these, to adjust, to adapt to the Green Bond principles, to the social principles of the UN, to frame this into what you mentioned, the social bond framework. Also, just a little additional background, we decided also to create a Green Bond framework, which was initially created in 2019 when we issued the first green public bond, and it was really very, the impact of the social bond framework helped a lot to add demand. It was three times oversubscribed, and we decided to increase the amount of the bond. So like noting, as well as the social bond that I will speak about now, but all these frameworks help a lot to have a further reach with in different markets and with different investors. There's a greater volume and mass of investors and of liquidity for these type of projects. And knowing that Central America is one of the more vulnerable regions in the world in terms of inequality, poverty, in terms of the environmental impact. Just to mention quickly the Mitch hurricane 20 years ago, just to mention as well, in 2020, there were two hurricanes that impact and devastated certain sectors of the region highly, with a very high impact, the Yeta and Iota, 1 week after the other. So we need to finance, we need to create facilities to help develop these redevelop the economic impact that all these COVID hurricanes have in the region, the inequality. And for instance, CABEI has created two big facilities recently, a $3.4 billion facility for COVID recovery, and a $2.1 billion facility for the recovery of the region after the hurricanes in 2020 that I just mentioned. So this more than $5 billion put into work in the region needs to be financed in some way, and then these frameworks help a lot to receive funding from different markets and different investors. So as you mentioned, and all this is background to the question, and so as mentioned, the social bond framework was created in 2020 by the end of last year, and then we begin to have the first steps in order to have a further reach going forward. So with the green and social bond framework, we have raised more than $1.6 billion for the bank. We have a $1.5 billion financing program per year. We are not as huge as IDB or as CAF mainly. That's our current funding requirements. And so we have put this first step in different markets. We have made this year more than $1.12 billion of financing, and we have had inaugural bonds in the Mexican market, inaugural social bond in the Mexican market, in the Swiss market, inaugural green bond in the Swiss market as well, and also our first social bond in the 144 Reges market, in the global USD market. So I think that from the capital markets point of view, we are doing the first steps to grow this further. What I see in the future, I see, I mean, there's a lot of investor appetite seeking this type of impact in regions such as Central America or Latin America. So we will continue diversifying markets and having a more international reach of our capital markets activities. We see as well a specific thematic bonds, for instance, for gender and for women, application for women advantage. We have, for instance, a facility of $600 million in El Salvador, out of which $100 million is for SME, basically owned or controlled by women. No? Out of 22,000 SMEs that have a positive impact of this facility, 14,000 are owned or controlled by women. No? So that's a specific transaction that is helping this inequality and economic poverty of the region. So we see, I see more specific thematic bonds. Maybe there won't be the 500 million or 200 million bonds in certain markets, but it will be at 20, 30 million, but more specifically for women, for coffee. No? You know, it's a very important product of the region. Also, we see further development of new categories and taxonomies, for instance, blue bonds. So I will be willing to discuss with the panel later on, about this. Have the experience of Slav, of Carolina, or Eusebio, Patricia as well, to develop these new categories, these new taxonomies, which would be very important to have a positive impact in the region. Lastly, I will only mention that in the financially wise, we are, CABEI is growing, so we have increased our capital from 5 to 7 billion last year in the middle of the pandemic. And the Assembly of Governors have decided to increase the capital from 7 to $10 billion, trying to have additional international members. So that there's also another way in which we will expand and increase our scope of our activities.
Jesus, thank you very much, because this was precisely the point that I wanted to end this discussion on. And I'd like to give each one of you a chance. We'll start with Carolina and go through the same order. Think about the participants who would be interested in talking about future Europe, sustainable Europe. there will be a lot of participants out there who are in Europe, who are interested in the Americas, who are interested in opportunities in Latin America. You are closest to the action. You see what is coming up in the future. From each of your perspectives, and we only have 6 minutes, so please be very short, what would be the most important either theme or process or subregion that you can advise the participants of this session to focus on in terms of ESG investing in Latin America? Carolina, any thoughts in terms of what you would advise participants of this session in terms of ESG investing in Latin America?
Thank you, Glenn. Yes. I think we have to start thinking in territory, in rural territories, in cities, in coastal marine territories, insular. We need not to segregate by sectors specifically, because the development and the communities and society, we are affected in our territory. And if we can think in proposals that are integrated with water, education, mitigation, energy, in different types of territories, that would be, I think, a plus in climate action.
Very clear. Territorial units, very clear, Carolina. Thank you. Slav, from your perspective, what should they keep their eyes on?
Yeah, all of the above. The region has a lot of needs, an amazing amount of diversity. So it's difficult to put in one bucket a Belize and a Chile, right? I mean, you saw how light years ahead Chile is already in terms of their sovereign debt management operations, and so perhaps less of a recommendation and more of a plea, especially to the financial community and the DFI community, to continue thinking creatively how to develop blended finance and risk mitigation instruments to crowd in the private sector in innovative, sustainable debt, sustainable finance transactions. I mean, you saw in my example the pivotal role that the DFC played. IDB is certainly teed up to do the same. And so it's important for our European friends, and I'm from Bulgaria, so an honorary European. It's important for our European friends to also step up to the plate. The European Investment Bank could be doing more. The European Commission could be doing more to help de-risk these transactions. Thanks.
So innovation, creating more opportunities for innovation, very clear. Eusebio, what would you say in terms of what potential ESG investors should focus on?
If I had to pick one theme, Glenn, I think it would be transparency. Transparency is necessary to avoid greenwashing, to ensure the funds raised through green bonds really reach their intended purpose, and to make issuers accountable, to hold them accountable for their alleged climate action commitments. For that, I would like to offer you and the audience a tool we developed at the IDB group, the IDB's Green Bond Transparency Platform. That's a database we offer free of cost to all issuers, second-party opinion providers, investors, where they can really easily access and get an insight in the richness of the green bond and sustainable bond market in the region, looking at issues, looking at impact reports, second opinions, everything on one platform. The link is www.greenbondtransparency.com. You can also Google IDB Green Bond Transparency Platform. And
we're nearly out of time, Eusebio, but I think that sounds like a very, very useful tool. Patricio, very quickly, and then to Jesus, what is the one issue that you would advise they focus on? Patricio.
Yes, on my side, very short. I think that the investor would like to see more in the very short term, more impact into the environment protection. So your use of proceeds is very useful, very important. It show what the government are experiencing in this topic, but maybe the SLB, what is effectively an impact that they can evaluate could be also an alternative. We are analyzing this possibility to issue in the very short term or next year. Also, we are seeing not only the mitigation but also the adaptation. For example, the blue bonds or some KPI that will be related to the protection of the ocean, for example, could be an alternative that the investor
Wonderful.
could see very well.
Thanks very much, Patricio. Jesus, very short.
Very short, few words. Glenn, I think innovation is very important. It developed new categories, developed KPIs that really have an impact or further impact every time, more impact in each category. And I would say blue bonds, blue thematic could be very important in Central America and in many others.
Excellent. Thank you so much, Carolina, Jesus, Patricio, Slav, Eusebio. I think you've done a terrific job of giving a snapshot of where things stand in terms of innovation, in terms of how we're starting to continue to address inequality, as well as help conserve the rich biodiversity that we have in Latin America. Again, from SE for All side, pleasure to have participated in the moderation of this panel. I would like to turn over to Hans-Jürgen Walter, Global Leader of Sustainable Finance at Deloitte, for the next part of this program. Hans-Jürgen.
Thank you very much, Glenn, for the handover. So yes, it's on me to close the session today. So dear ladies and gentlemen, dear speakers, and dear partners and friends. So thank you for joining our today conference, Future Europe, Sustainable Europe, so our global winter edition. And in the course of one day, we traveled all around the globe, of course, completely virtual, to gather the most important sustainability ambitions to drive one coherent sustainability strategy. So we discussed today about net zero in investor portfolios, about COP26 and global standardization. We talked about sustainability in emerging markets, the importance of Africa, energy, sustainable cities, and sustainable finance in the Americas. So together with our global experts, we could address these topics and discuss strategies together, which we will hopefully turn into action in the next term. So I would like to thank all speakers for their commitment today. So what have we learned today? Personally, I could gather three key messages throughout the entire day. So one, a global community to form coherent sustainability agendas is absolutely key. Second key message from my perspective, financial institutions need to accelerate collaboration with their key stakeholders. And the third key message of the day, from my perspective, ambitions need to be measurable so they can be turned into action and become adaptable. So at Deloitte, I'm with Deloitte, we are confident that the financial services industry can boost credibility through measurement and transparency. So it is transforming itself, adapting and strengthening in exciting ways. And even if we do not have yet a common measurement standard, and we heard today that there is, of course, with the ISP, a initiative which is hardly trying to get this global standard, financial institutions can start to build a robust and efficient approach for measuring financed emissions. So we have detailed this approach in our last publication with the title, Tackling the Challenges of the Net Zero Transition, how the financial services industry can boost credibility through measurements. So if you are interested, you can find this paper on our Deloitte website. To conclude, speed is essential on climate change. And I'm convinced that we can all try the discussion in the industry to get a common and efficient baseline and tackle the challenges of the net zero transition. Looking at the future Europe series itself, so I'm happy to see that the community is growing from every event to the next one. And that awareness is being created through the constant knowledge exchange which we have during all of these sessions. So thanks to the Future Europe team, we can, even during the times of pandemic, reach out our partners, clients, and interested parties to join our mission to accelerate global funding for sustainability. We are looking forward to seeing you next year at the next Future Europe Sustainable Europe event. So stay tuned for more information and join us on our global mission. But for now, Merry Christmas and a Happy New Year, and stay healthy. Thank you very much. See you next year. Goodbye.